What's up, everybody? Welcome, guys. Welcome. We're going to start here on like a minute. Just want to welcome everybody here. Happy New Year. We're going to start the year right, guys, with financial education. We have today with us Chief Market Strategist at Miller Tabak, Matt Maley. He's going to be with us today. I believe he's in the back. In the meantime, guys, go ahead in the chat. Let us know where you're tuning in. We always want to check that and just get a feel for where you guys are checking us out from. And we're about to start here. So let me get this timer out of the way. And all right. I believe Matt is in the house. Mr. Matt Maley, give me a sign, thumbs up there when you're good.
Hey, Rodrigo, can you hear me okay?
Hey, Matt, Happy New Year, man.
Happy New Year.
Good stuff, man. Good stuff. So, well, look, January 2nd, I mean, I think this is a great time Number one, well, before we do get into all that stuff, because we're all excited about getting into the markets this year. But for those that are not familiar with your background, if you don't mind just giving a brief touch of your experience on Wall Street, Merrill Lynch, all that, part, and then we can get into a couple topics here that I have planned out.
Sounds good. Yeah, just give you an idea of what what my background is. I've been on Wall Street for almost 40 years now, and I started out in the trading business for 25 years. And one of the things that is I'm the chief market strategist at Miller Tabak, but most strategists are they're the ones that they worked as analysts, and that's fine. They worked as economists, and that's fine. But they're more on theoretical, what should happen, and what should happen over a long period of time, and over a longer period of time. And that's great because we all want to have a certain amount of money, a bucket of money that we have with that long-term horizon, 3, 5, 10 years out, even longer, 20, 30 years out, if that for some of the younger people. And but for those of us who really want to be active and want to be really involved in the market and really want to maximize our returns, it's nice to have another bucket on what's going to happen on the more short to intermediate term. Maybe it's the next few days, maybe it's the next few weeks, next few months, or even the rest of that day. And when you trade, maximize the returns. And as a trader, rather than an analyst for 25 years, that really helped me to know what's going to happen. Because if just giving more details of it, I started off on Salomon Brothers. Some younger people may not have heard of them, but you may have heard of the book Liar's Poker, which is a great one from the years of Wall Street way back in the 90s. But Salomon Brothers in the 70s, 80s, and 90s was the most important, most powerful trading firm on Wall Street, and along with Goldman Sachs. And Goldman was bigger on an overall basis with M&A and things like that. But for trading, Salomon was at the top. Now, I wasn't there for all those decades, but I was there for 15 years in the 80s and 90s. And when I was doing that, I was covering the biggest trading desks on Wall Street, whether the institutional desks, mutual funds, banks, insurance companies, hedge funds, Fidelity, BlackRock, you name it, the whole gambit of it. And again, when you're there and you're making bet, or you're trading on a short-term basis, we don't care if the stock is going to double a year from now. Okay, we care where is it going now, because I've got a short-term position that this customer I've gotten from this customer for whatever reason. I've made a market. I've got a position. I got to get out of this position. Am I going to make a profit on it? Am I going to take a loss? And the most important thing is cut the losses. Where's it going to go over the next few hours, the next few days? And that's really what is happening in the market right now, not what should happen. And of course, theoretically, what should happen doesn't always play out anyway. And then I moved on to Merrill Lynch, where I did, again, one of the most important and certainly the biggest trading desk on Wall Street for 10 years. So a total of 25 years before I moved to Miller Tabak, and still was involved in trading there for a while, and also as a strategist. And then I became chief market strategist. And again, working on these types of things where you can combine a lot of different things, not just those fundamental values. Fundamentals are very important, don't get me wrong, but also using other things like technical analysis, positioning, sentiment, etc. Bring them all together so that you can get really big, make some calls on real key turning points, not just long-term turning points like I did October of last year, 2020, about 15 months ago, on the energy stocks, long before anybody else did, but also on intermediate and short-term calls that, again, when people get too far to one side of the boat and you can get a key turning point, you're going to be able to make that much more money, because not only do people say, oops, I'm wrong, okay, the leverage, so they have to sell their position, or if they're short, buy back their position. The leverage players have to unwind that leverage, and the whole thing really moves in a big way. It can really maximize the gains. And of course, when we leverage that ourselves in options, you can really make some great returns. And that's when we've been able to do, I got this stock pitch report that I put out, but we now have in the last 6 months put the chat room. And it's a way for us to talk all day long about the stock market, what's going on, what short-term, intermediate-term trades are working, what are some of our long-term picks, should we trade around them. For instance, one of the things we'll talk about, how I've been bullish on the banks for a long time, but right now I want to shy away from them. And we can kind of trade around those positions, and again, maximize even our long-term plays. And so, this is something that, and I guess the big thing though is that is that not only do I try to help people make some good picks, whether it be, again, long-term, short-term, but on the chat room, the more on the short-term basis, but more importantly is educate them. Let them know, because there's so many misnomers out there on Wall Street. One of the best old sayings on Wall Street is that the market is always right. And that is maybe the worst saying on Wall Street. One of the best sayings is don't fight the Fed. That's probably the best saying on Wall Street. One of the worst ones is the market is always right. And the reason why I say that is that, yes, the market is always right, but it's only always right eventually. We all know a million times. What was the stock market right in 2000 when all those tech stocks were going through the moon? Of course not. Was the market wrong? Was the market right at the bottom in 2009 at the end of the financial crisis? It was flat on its back. Stocks were cheap. It was dead wrong. And individual stocks and ETFs groups trade the same way, and that's what we want to be able to take advantage of. That's how. Warren Buffett, and he'll say he's not a trader; he's a long-term investor. But he's still a trader, because what does he do? He buys stocks, huge pieces of companies when they're completely out of favor, when they're like, oh my gosh, they have no place else to turn. Goldman Sachs, one of the great firms on Wall Street, for 100 years, the greatest firm on Wall Street for 100 years, okay? And what did they have to do during the financial crisis? They needed money. They were in big trouble. I didn't say they were going to go out of business, but they needed money. And they went in when interest rates were basically at zero, and they paid Warren Buffett a convertible bond that paid him 10% a year, 10%. Okay, when everybody else is making 1 or 2%, he made 10%. And so he is more of a trader than you think. And that's because there was a big dislocation. He saw that things were out of favor, that sentiment had gotten too negative on Goldman Sachs. He didn't bail out the company, but he was able to get stock and bonds at incredibly cheap levels. And that's what we try to do on not just on that basis, like 10-year basis, but on shorter term basis. And again, using all those 4 different areas to trade the markets.
Yeah, the cool thing about that, you were talking about the chat room, is that it's not like it's how do you say it? It's not like a set thing where it's like, it only has to be this. It can be different things, because you have that aspect of, you can ask, right? Like, hey, Matt, what would be a great value play that I could get into, thinking 4 years out? It can be whatever you want it to be. That's the great thing about it. Okay, good stuff. Well, just want to make sure that everybody understands really, more or less what we're trying to do here, educate retail traders, and especially because I'm sure many of them have already seen you on CNBC and Bloomberg, and whenever you do your world tours, you go out on on these places. But that's very good, Matt, and we appreciate it. So there's a couple of things I was looking in the market: 52-week highs, companies that I've stopped hearing about for a long time, like Coke. What's the last time you heard about Coca-Cola? Doing a 52-week high, or CSX. So what do you think about those particular stocks in that sector? And if you don't mind, just go ahead and take over the screen with your terminal, and just your thoughts on that particular, because it's a name we don't hear too much about.
Okay, hold on 1 second. Okay, can you see my Bloomberg okay?
Yes, we're good to go.
Okay, good. Yeah, one of the things that we'll talk about. Wait a minute, I just want to move this so I can see my full screen here. Sorry. One of the things we have right now, you talk about the number of stocks hitting new highs. One of the big concerns right now, of course, is that even though the S&P is at all-time highs or very close to it, and the Nasdaq is close to its all-time highs, the number of stocks hitting their 52-week highs versus lows. There was more stocks are hitting 52-week lows than are hitting 52-week highs by a wide margin, especially in the Nasdaq, and that's a concern for me. And so, because it's just, you can see how narrow this rally is in a small concentrated number of mostly high tech names. But we're also seeing names like Coca-Cola, and some of these, you think of Coca-Cola kind of as a consumer discretionary, but in a way, it's also a staple. And I think that some of these staple stocks, and they could refer to the consumer staples, the Walmarts of the world, the Clorox, Colgate, Procter and Gamble, because people, if we can talk about if times are tough, if inflation is high, well, I'm not going to go spend a lot of money going to dinner. I may go to, and I'll go buy my stuff at Walmart rather than Bloomingdale's, or Bloomingdale's even still around, but one of those high-end stores, Tiffany's. Or if or am I going to, and with inflation going up, I'm going to, again, I'm going to go to the Walmarts and pay less, but I still got to buy my soap, my detergent, my food. And so these staples are more defensive names, and they're also names that pay a very nice dividend. In other words, they pay you to wait. And I just want to see here. Yeah, I mean, it's almost 3% on Coca-Cola. I just wanted to make sure I check that out. KO, Knockout. Coca-Cola. The nickname is Knockout, KO. Anyway, but you can see that this stock is making a new high. And the reason why I highlight this is that for most of this year, the consumer staple stocks really have been underperforming, and rightfully so. I mean, the stock market was up 22% this year, and they were just, the whole market was flying. What? I'm going to go to the growth stocks. They're the ones. Well, why would I buy Procter and Gamble when the economy is doing well, it's bouncing back nicely. People have all this pent up demand. I want to go for high tech, the big tech names. I'm going to go for maybe some of the washed out cruise stocks, which worked really very, very well for a while anyway. Things like that. However, in the last 6 weeks, especially in the last month, the consumer staple stocks have been taking off, and they've been outperforming actually by a wide margin. I mean, when we had this big rally at the very end of December, you saw the S&P rallied 5% off of its December 20th lows. But the XLP, which is the ETF for consumer staples, is up 10%. They're boring names. How could they be around that much? Why? Because the smart money, the institutional investors are now saying, I'm worried about what the Fed's doing. I'm worried about inflation. I'm going to get more defensive because, again, number one, people have to have these things. Their earnings won't be hurt as much. Number two, even if inflation comes, they'll be able to raise prices because it's what they sell are staples, not discretionary things. And then number three, a lot of them pay very nice dividends, and especially the place like Colgate and things like that. So you get 5% dividend, and they pay you to wait. So even if the stocks don't go up a lot, if the overall market has a tough time, you'll get that nice dividend and pay you to wait. So that's why we're seeing this kind of barbell strategy amongst institutional traders, where they're still holding in there with the Apples and the Microsofts of the world, but instead of buying the other ones underneath it, the other tech stocks underneath it, they're going away from those names and buying the consumer staples. And that's why this year, 2022, I think it's going to be another volatile year. It's going to be a tough year for the stock market, but it's going to be a tough year for the stock market indices, and a great year for traders and stock pickers.
Absolutely. And I've had, since I started trading, I had my watch list is getting smaller and smaller because the list of companies that are, well, at least on the chart, that is looking good is always getting smaller and more narrow and narrow, I feel now, especially with growth being hit so hard. All right, Matt. So Tesla, right? They had a big recall, but then they also had record deliveries, beating last year's record. So where are you with Tesla? Because I know you're in and out of it in the chat room and trading around it. So where do we stand with Tesla?
We talk a lot about this one all the time, and I mean, almost daily. And we've been able to catch it really, really well. Not perfectly every time. A couple, for instance, right here when I called for a top and we made some, several 100% and some put options, I was a little early. So we lost small amounts. And of course, that's one of the biggest things about trading is letting your winners run and cutting your losses. So we were able to cut the losses there and then get right back into it. When it rolled back over, made some very nice money there. But you can see here with this stock, what I'm worried about, great company. I think it's going to do very, very well over the long term. But part of what's going on, but before we move on, I'm going to go on to a couple things. But after I talk about Tesla, just a couple things about the broad stock market and why I'm a little bit concerned about it and why it could negatively impact Tesla over the short term. And that's because the stock has been part of their rally. I'm not a long way from saying all the rally, but part of the rally, the big rally they've had more recently in the last 21 months since the bottom of the pandemic was that the Fed provided massive amounts of liquidity into the system. That's why Bitcoin went more than it should have gone. I'm a long-term bull on Bitcoin. The good thing about Bitcoin, it's down 25%. It's already washed out some of that froth. Tesla, I don't think it's washed it all out yet. The stock is a great stock, a great company, but I do think it risks going down to its 200-day moving average, which is way down down here near below 800. Let me take some of these lines out of the here, so it's not quite so. Now, we had a person in the chat room who didn't like my call up here. I said the stock's going to trade below 1,000, and he thought I was nuts. And but I was like, hey, I'm not a perma bull. I mean, some of these people on Wall Street, they're paid. Many of these people, most people, are paid to be bullish. That's what their real job is for whether you work for a brokerage firm or a mutual fund company. If you're a strategist in those areas, any kind of money manager, your job is to get the things in, the money in, and keep it in. And in fact, one guy who had a very, very big brokerage firm was quoted about 2 years ago saying, it pays, job security is much better as a strategist if I'm bullish and wrong than bearish and right. Now, the market usually goes up, so it pays to be bullish, but they're paid to be bullish, okay? I tell you why like it is, because Tesla, no matter where it's going, how much it's going to change the world, it has had many, many dozens of corrections, deep corrections in the past, and they will have it in the future. Amazon, this is one I use all the time. Last 25 years, it has completely changed the world, completely changed the world. And then in 2001, they had their revenues and earnings skyrocketed, and yet the stock went down because the whole market was going down. Blaming on that. But the point is, Amazon has had two dozen corrections of 20 to 60%. It went down 90% when the dot-com bubble burst. 20 to 60% since then, and yet the stock is continued to go up on a very long-term basis, and they've changed the world. And so, in other words, Tesla can still have these, and it will not go up on a straight line. Now, and my concern is once the Fed pulls in their horns, and people unwind some of their leverage. The investors, these leveraged investors who've taken on too much risk, they're going to have to pull back on a stock like this. That's okay. It provides an unbelievable opportunity. But even look at the chart right now. One of the key things we always like to talk about, is it making higher lows and higher highs, or is it making lower lows and lower highs? Here we had stock looked great, came down, lower high, okay? Low, and then back here, lower low, lower high, lower low, lower high. I think it's going to come back down here, likely at some point, not in a straight line, not going to happen all at once in January, but it's probably going to come all the way down. Look how good that 200-day moving average, that's going to be. This is where you're going to want to back up if it happens. Now, no guarantee, but boy, you back up the truck when it gets to this 200-day moving average, you're going to do very, very well, because if it gets down there, especially if it gets down quickly, you're going to have some people being for it, no matter how much they like the stock, because they have too much leverage in the whole market. They're going to sell what they can, and they're going to sell a stock like this, and because they'll get margin calls. It may not be in Tesla, it might be in some other stock, and they're going to say, I've got to sell the stock. And that's when it's, when people, again, when I talk about key turning points, those who can keep their heads while others around them are losing it, as the old saying goes, I forget, one of the old British writers wrote that, and those are the ones that are really going to succeed. If I can, I'd just like to talk a little bit of educational thing right here, and why I'm worried about the market here, and what I'm looking for next year, and why I think it's going to be really, really a great year for those who trade. In our chat room, we're going to really be able to do really well. But those who don't just sit there and buy the index funds and sit on them, because I think they're going to have a rough time. What we're trying to do here is make educated decisions, not just guesses. And my thing is, and I've said, keep talking about key turning points. Well, I think we're at one now. And again, I say now meaning today, it may be a couple of weeks from now, but I do think that we are in the stock market. Again, it goes back to what the Fed said, what the Fed is doing. So many people, the perma bulls on Wall Street, always say, don't fight the Fed, don't fight the Fed. They always say it when the Fed's loosening, when the Fed's easing, when the Fed's providing stimulus. When the Fed starts tightening, somehow they forget that rule. Why? I don't know. And even one guy last week, really well-known guy, and is very successful, but he said, tightening isn't negative for the stock market. I'm like, that's just wrong. I don't know how else to tell it. Every time the Fed tightens, the market always goes down. Sometimes there is a big lag. I don't think there's going to be a big lag this time. A third of the time, it happens immediately. So it would happen really, basically in the next month, it would start going down. but it doesn't matter. It happens rather quickly. Once in a while, and back in the 2007, 2006, it took almost a full year. But the stock market wasn't incredibly expensive back then. Margin debt wasn't, in other words, leverage wasn't really, really high. And so because it's so expensive this time around, I think that the pullback in the market, which always happens, will come earlier or sooner rather than later. And but again, corrections are normal. They're healthy. They're part of capitalism. They're part of the Fed, and the Fed does not. It's not their job to keep the stock market rising forever. They did do it right in the few years right after the great financial crisis, because they had to. The system needed the stock market rallying because the system was so fragile. They did the same thing in 2020 because the global economy had completely stopped. Okay, and that meant that the financial system, things weren't running. I mean, the people weren't buying and selling stock. I mean, people could not get a market. They called up top tier brokers and said, make me a market in treasuries at the depths of the crash in March 2020. They wouldn't even make a market in U.S. Treasury notes because they were so scared. They had no idea what was going on. Luckily, the Fed came in and did the right thing, added a massive amounts of liquidity because they needed the markets to go back up. We needed the market to get back up to a level that was artificially high and let the stock market let the economy play catch up. That worked out very well. The problem is the Fed kept that emergency level of stimulus going long after the emergency had ended. So as it played catch up, then all of a sudden they both kept going. It's never been able to play catch up. Now that they're taking away that stimulus, the stock market's going to have to come back down. Hopefully they'll meet somewhere in the middle. And unlike we had in 2011, 2012, when the system was still very fragile, the consumer's strong, the banks are in much better shape. The stock market can withstand a pullback. And the Fed has talked about this in their minutes and in their interviews. Part of what they're worried about is the extreme valuations in asset classes. They did this in 2018. I don't want to drone on too long on this, but in 2018, people think they made the mistake of thinking when the stock market got really hurt, they completely flip-flopped. It's not true. The facts tell just the opposite. December 15th, 2018, the stock market was down 12% in correction territory, and yet the Fed still raised rates at their meeting. They weren't worried about the stock market. It was very quickly thereafter, about 2 weeks later, less than 2 weeks later, the high yield market started imploding. Spreads started widening. The high yield market was still fragile from the oil crash of a few years ago, and so they had to reverse, not because the stock market. They didn't worry about the stock market coming down. They're not worried about that. They were worried about the credit markets freezing up. And I guess my point is that's what they're doing now, in my opinion. They're okay. The Fed put still exists. They still have a safety net under the market. It's just more out of the money. In other words, they're telling us it's going to be a lower safety net than it used to be. If the stock market can come down 10 or 15%, I'm telling you, they'll be happy as long as it doesn't have an impact on the fixed income markets and on the overall system, because they can't keep it going. They can't let inflation skyrocket. That will create all sorts of problems for the economy. Their job is real job is to smooth out the economy. When it gets too hot, slow it down. When it gets too cold, heat it back up. It's not to keep constantly rising. They only did that on 2 occasions in the last 12 years because we were in crisis mode. Right now, they love to let it come back in, settle back down. It's the right thing. It's what Paul Volcker did in 40 years ago. It was painful near term, positive long term. I think that's what the Fed's doing now. Either way, when the Fed change, and they're not going from a neutral stance to tightening. They're going from a historically massive level of stimulus to zero in just a few months, and then raising interest rates. From massive stimulus to tightening, that's got to have a somewhat negative impact on the stock market. Another thing I worry about right here, if you look at these margin debt, this is talking about leverage. Probably gets a margin call because they have too much leverage in the marketplace. Look how much higher it is. If you hear all the time, margin debt is a lousy timing tool. Absolutely true. In fact, it's very bullish because if people are adding margin, if people are adding leverage, that can help the market go higher. It's only when it starts to roll over. Well, what did it do? It's when it started to roll over here in 2000, very early 2000, here in middle of 2007, 2018 didn't cause a major bear market like these two did, but it still caused a decline of 19%, almost a bear market. And now we're starting to roll over again. You see, so we're repricing money, we're repricing risk, we're repricing leverage. It has to come down, and that will bring the market down. Hopefully they'll do it rather gradually, but it has to come down. And it just, at least in my opinion, and with the Fed changing so much, everybody's talking about Omicron variant. As long as we get past that, we're going to be fine. Inflation's still going to be here. The supply chain issues are going to stick for a while, but more important thing is wage pressures are still here. So inflation, even if it comes down, is going to stabilize at a much higher level than it had been. And all the smart people are saying that. So the thing, I guess my point is, we're going to a situation right now where the Fed is going from extreme confidence. Let me step back. You have the two biggest economies in the world are starting to pull on their horns, or have already pulled on their horns in the case of China. And the U.S., they've gone from massive record levels of stimulus, $125 billion a month. By March, it's going to be zero. Okay. You have the China. Okay. China went from more than a decade of encouraging debt, encouraging risk taking, encouraging leverage, to now where they're clamping down on all three. And they've been doing that for a year now. So you get the two largest economies pulling their horns a little bit. That's a concern. Everybody's talking about how great earnings growth is. Yeah, I mean, earnings are going to be, should still be fine. But after the third quarter's earnings, which were so incredible, they were really, really good. Guess how much consensus earnings estimates for next year went up? Zero. They didn't move at all. Why? Because the forward guidance wasn't any better. That was a big change. After first quarter earnings, after second quarter earnings, everybody raised their earnings estimates for the S&P 500 a significant way. They ended up raising them by 20%. That's a huge increase. Usually estimates come down as you go through the year. This year they went way up, except after the third quarter earnings. Then they came out in the fourth quarter in October. They were measured for the third quarter, so they came out early fourth quarter, and people didn't raise it. So earnings growth is starting to stall out a little bit. You got to be careful. But the most important thing, as I mentioned, leverage works in both directions. Again, we all hear so much when if we do get a pullback and a lot, the Wall Street guys, even the perma bulls are admitting, hey, we'll probably see a correction this year. Well, given that we see a correction almost every year, they're giving that obligatory thing, but they'll say, but everything's still going to be fine. That is fine. I mean, it is going to be fine, I guess is my point, but let's profit from it. Most of them try to say, so we're going to help you weather the storm when we do get that correction. I'm saying, why should we just weather from the storm? We can profit from it. And today's marketplace, there's many more ways to do that. I mean, back when you go all the way back to 1929, but you go back in 1999, 2000, when the market, obviously the bubble burst, you didn't have many options to bet on the negative side as an individual investor. Now, did have options. You could buy put options, but they were only quarterly options. So for time value, you had to pay a lot of money for those options. Today, we have many, and all of the major stocks, but many other stocks who have weekly options. So you don't have to pay that big time value in there. You can buy some. They're much cheaper to buy, to play in, and same with the calls as well. And the other side, of course, is that we have inverse ETFs. We have and the major ETFs of the indexes, which is the SPY for the S&P 500, the QQQ for the NASDAQ, and the IWM for the Russell. They expire 3 times a week, Monday, Wednesday, Friday. So you can go out just a few days if you want and make some good money. So and then of course, when you see a big dip, then if we do see a correction, which I think we will, I think it's going to be a deep one, there'll be some bounces along the way. So we'll be able to run in there and say, okay, I'm going to buy the QQQ call options just a couple of days out and make some nice money. But my point is, in the past, it was only institutions who really could do. They had over-the-counter options, and they could anything they could have an expiration date of anything they wanted. Individuals hadn't had those in the past. Now we do. And again, I'm just trying to go back, and fundamental analysis is very important, but I use technical analysis heavily, and we'll go into that later on. But why technical analysis is actually fundamentally based. Sentiment reasons, when everybody's on one side of the boat, sentiment and positioning. When everybody's negative and everybody's short, okay, there's nowhere to go but up. That was one of my things where I said, it was like last September, October, I was pounding the table saying, everybody's saying fossil fuels are dead. Don't buy energy stocks. I was saying, number one, fossil fuels are dead several decades from now. We can't go straight to green energy automatically. It's going to take time. And the stocks were cheap, wildly underowned, very oversold. So we had positioning that the futures traders were all short the crude oil, they were short the stocks, etc. And I pounded the table, and they've had a historic rally this year, but it's really started in October of last year. And most of Wall Street didn't jump on to the bandwagon for 6 months. So I could I'd go on and on. It's start rambling there, but I just wanted to just talk a little bit about why I think there's going to be some unbelievable opportunities here. I don't want to sound overly negative. I just think, and it may not happen for several more weeks,
Right.
But don't fight the Fed works in both directions. And now that the Fed is turning negative, turning on the tightening side, we're going to be some great opportunities. And those who have been bought every dip last year and done well with that are going to have a tougher time, I think.
All right, so let's do this, Matt. So I know you've been following AMD, right? And I know you're familiar with this company called, I think it's Xilinx. I don't know how to say it, but it's AMD's trying to acquire that company, correct, in the chip space, right? Something of that nature. What are your thoughts on AMD? Do you think it could ever be like an NVIDIA or better long term?
Well, here's the thing about Advanced Micro. The one thing is, sure, I think so. Yes, I love the stock long term, and they are. I mean, their new CEO. I say not. She's not so new anymore, but she's done an unbelievable job. I mean, I remember when they played second fiddle to or third fiddle to Intel and Texas Instruments, and that was before NVIDIA was really a force. I'm going back obviously 15 years or more, but they've really turned things around, and not just in the last year. I mean, in the last several years. However, we do need, again, everybody's so bullish on the base, especially so bullish on the semiconductor, these chip companies. The CEO, or the former founder of Cypress Semiconductor, who's still heavily involved in the business, in the industry, not necessarily. And he is worried that he said, hey, I remember when everybody said, semiconductors, chip stocks can have nowhere to go but up. And he said it's starting to remind me of that. He didn't think it's as bad. It's as extreme as it was back then. But I'm going to go back to that. Whoops! I have to drudge report up. Oh boy, what do I got here? Bang. Okay, I'm going to go back. I'm going to put this slideshow in here, and I'm going to show you something about the semiconductor industry, and then I'll go back to AMD. Okay. Because I put a bunch of charts together. Oops, there it goes. Okay.
Yeah, and they want to see some pics from your chat room as well. I know
we'll do that. We'll definitely be doing that. So, but here's the SMH. Everybody has been talking about how great the group has acted. This is true. It has. Look at that huge rally it's seen. The thing is, most of the rally took place in October, 6 weeks from early October to mid-November. Since then, it's been bouncing around, okay? And they say, oh, it rallied really strongly at the very end of the year, although, between the 20th and the 27th or so. Yes, but it rallied from an oversold condition after it actually got hit pretty good. And now it's starting to roll over again. This is what they call as a rounded top. I'm sorry, take that back, not a rounded top, a broadening top. Okay, when something has had a very nice rally, which it had for all year long, but especially recently, then it gets really choppy because, and again, there's thinking behind it. It's not just a bunch of lines drawn on a chart. It's called, and some people will call it also, its nickname is a megaphone pattern. Okay, you can see why we call it megaphone. And what happens is people start getting so, usually you sit there and you say higher low, higher high, and if it makes, it can come down and hit a thing and then make a higher high, and we call it an ascending triangle pattern. But here it's making higher highs and lower lows. You don't see that very often. You'd be surprised how little this happens. And it tends to show that people are starting to lose confidence. Investors, the insiders, really know what's going on. So I'm worried this thing could trade back down. Again, the overall market, it would be a big surprise. It's not my base theory right now. If it can break back above here, it's going to be just the opposite. So we're kind of a key level here in these semiconductor stocks, and we need to be careful on how we trade them over the coming days. And look at this here. You see how it broke below its 50-day moving average, but not by much? Then it got here to its 50-day, bounced off it again, broke slightly below it. We always want to remember technical analysis. Whenever you break below a support level or above a resistance level, it has to be a meaningful break. If it's just a few pennies, it's not a big deal. You want to see it at least 2%, in my opinion. A lot of technicians will say at least 3% before it really tells you something. But what I'm concerned about is we did make what looks like a higher low. We've had nice higher high, higher low, higher high, higher low, higher high, higher low, but now a lower high. That's a warning flag. Are we going to get them follow this with a lower low? I'm not sure, but you see, if it breaks below this 50-day moving average, this group has not been acting well the last couple of days. And again, we could go into all sorts of different things that I look at. The MACD chart, you see this? It's rolling back over. Now, what's the MACD? Again, an educational thing here. MACD, a lot of you I'm sure have heard of what a golden cross or a death cross is. And the golden cross is when the 50-day rising 50-day moving average breaks above the rising 200-day moving average, and it doesn't happen at the beginning, obviously, of a turn of a change in trend, but it shows you that, hey, this change in trend confirms a change in trend. It really gives you a real bullish feeling. It's just the opposite. Is it's called a death cross, with a falling 50-day moving average drops below a falling 200-day moving average. In this case, a MACD is very similar. It's just shorter term. They use the 9 days and exponential moving averages, but the 9 and 12-day moving averages, okay? And what happens here is, you can see, look what happened in AMD. Each of the last few times it saw a negative cross. There had a tough 2 months. There had a tough couple of weeks. Here it was about a full month. You can see that sometimes you get, like I said, here was a little minor negative cross, but it never really materialized. It was a head fake, so it really didn't turn out. But this one hasn't happened yet. But if it does, it could be a head fake, just like this one. And it could bounce right back, bounce back off that 50-day moving average, just like it did before. But looking at the technicals, no matter what the long-term fundamentals might be, looking at the technicals, if you get a negative cross here, especially because it'll be a negative cross at a lower level, that's going to tell us that the intermediate term momentum for advanced micro devices is going lower. So I guess my point is, I'm a little cautious on this group right now. If it breaks below, if it breaks down, which I'm kind of hoping it will, because it will provide an unbelievably great buying opportunity several weeks down the road. But again, I will also be watching this 50, this 50-day. If it bounces strongly off that, especially if it bounces above that level, then it'll confirm that this lower high was just a head fake, and we're off to the races. Long term, we still love it. And for the fundamental reasons that you talked about. And Intel, they've got a new CEO, and he's turning things around, but that's talk about trying to turn around a battleship, and that takes a long time. And I think they'll be successful over a little bit longer term frame. But I do believe that AMD, Advanced Micro, will be one of those things that we'll be talking about in the same vein as NVIDIA in the years to come.
Okay, and we got somebody here in the chat asking, Matt, your thoughts on banking stocks. And it's funny because I think, isn't the banking sector having like their best run in decades or something like that?
Yes. And it's funny because this is, again, a group where I turned very, very bullish on in it's kind of the same time I turned. It was a little bit earlier than I did on the oil stocks. It was earlier in September of last year, again, 2020. And they had an unbelievable year this year. However, and the reason I did that was because I really saw a big change in interest rates. So I saw the yield curve was going to steepen. The group had finally fallen out of favor. People had loved that group for a couple of years, and it kept underperforming. They finally threw in the towel in the summer of 2020. So that sentiment and positioning thing really got me to like the group a little bit better. But then when I saw the change in long-term interest rates moving higher, and the technical basis that was, again, the positioning was set up perfectly for a significant rally. In other words, a significant rise in interest rates. And sure enough, they went from 0.5% to 1.5%, which is a huge move. I saw that coming, and I turned bullish on the banks. However, I'm more, I don't want to say I'm negative. I'm just more cautious on this group right now. And the reason for that is, you look at the bank stocks, as good as they've done this year, and they've done even better if you start from starting point is in September, October of last year. But even then, I think we're up 35-40% this year on the KBE Bank ETF. The thing is, most of that rally came in the first quarter. I mean, the KBE is trading right where it was in March. So it's had some big swings, but it's definitely flattened out. And the reason why I'm concerned is that even though I do think interest rates are going to head higher, long-term interest rates will head higher, I'm not convinced that the yield curve is going to steepen, because short-term rates might move faster, may rise faster, and have been rising faster recently than long-term rates. So therefore, and think about it, why is that important? Because all I have to care about is, as long as interest rates are moving up, that's bullish for banks. Actually, it is bullish, but it's much more bullish when they're pulling away and the yield curve is steepening. Why is that? Very simple. You have the banks. They take in money at the long end. In other words, they make loans at the long money, and people pay off those loans at the long end, the higher interest rate. They pay out, okay, at the short end of interest rates. In other words, to pay out their depositors. Okay, so if long-term interest rates where they're taking their money in is high and where they're paying it out on deposits is low, that means their net interest margins are much better. NIMs, as they call them. Okay, if that flattens down and the yield curve flattens, they make less money. And so as much as I'm looking for higher interest rates, the fact that last year at this time, especially in the fourth quarter of 2020, it was only long-term interest rates that were going to rise, okay? And there was a number of different reasons for that, inflation and others. And we knew short-term rates were going to stay low because the Fed said they were going to keep them low. And so that made the yield curve steepen. That made the banks very, 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 very interesting. I'm going to go back, okay, to this presentation again. And I want to show you here my chart on that. Let's see if I have it here. Let's see here. Here it is. Okay, I'm going to open it up so you can see it a little bit better. Okay, now here is what happened. Okay, this is, see how it happened this year? Okay, we saw a big sell-off, this was the part of that big steepening part when the banks did so well, right? Now they flattened. Again, when we talk about the yield curve, we're talking about the difference between the 2-year yield and the 10-year yield, the spread between those two yields. Some people do it between 3 and 5, or even 1. They do different, but the one most people follow is 2 and 10, and they tend to move together anyway. So that's the one I use. But see what happened here, okay? As good as the banks did this year, they went down 15%. The KBE bank ETF fell 15% when this spread flattened. Okay, the spread tightened, which means the yield curve flattened. Same thing happened here. Okay, in November and into early December. Okay, the yield curve flattened, and the bank stocks, the KBE fell 10%. So even though they had a big year, and it's funny because on our chat room we talked a lot about that. It's like we like to be able to trade around our long-term positions. Even though I still like the banks long-term, I was like, hey, let's sell some of our long positions there in the KBE, and let's buy some puts on the or the KBE or KRE or the bank stocks, individual bank stocks themselves, and we can maximize our returns. What are we doing now? Okay, well, we sold off and then we flattened out here, just like we did here, flattened out, actually a little bit higher. In this case, we actually dipped below that sideways range, and I'm worried because I'm worried that short-term rates are going to move faster. I'm worried that this is going to break down. So that's what I'm watching for. I'm not turning negative on the group. I'm not telling people in the chat room, let's start buying puts on the KBE or on JP Morgan or Bank of America. What I am saying is that we got to keep a close eye on it, because if this thing breaks down, and especially if it breaks below that level, this group's going to have a tough time near term, next few weeks, maybe even the next couple of months. Again, I think eventually those long-term rates, as inflation really, we see what's going on there, inflation's going to really widen out. Well, the thing is too, is that oddly enough, when the Fed starts to tightening, the yield curve almost always flattens, and that's why we're seeing it. And that's why I'm concerned as they're really getting into their tightening mood, it's going to come down. But again, that usually lasts just for several months. Then the yield curve steepens up, and that should take the bank stocks a lot higher. So M&A activity is really strong there. They're much better, obviously way better shape than they were 10 years ago. And some of these managements, JP Morgan, Bank of America, unbelievable management teams. Citigroup's going to be interesting because they have a new management team. They seem to be good. We'll have to see. they've had a lot of their problems, but again, that could be one that works out really well. But we'll have to see more in the next couple of months. They report earnings, I think, next week. And then in the next 2 weeks, they're going to report. We'll see how they go. So that might be one we jump on early. But again, it's a group I love longer term, but I'm a little bit more cautious because I'm looking at what's happened to the yield spread. Too many people concentrate, when they talk about the banks, they concentrate on the 10-year yield. The yield curve, what I talked about, again, that net interest margins, that spread between the level they take money in and the level they pay money out, that's much more important. And as you can see, these are, I'm not, I wish I should have had the KBE on here, but I believe me, I'm not making it up. Went down 15% there, 10% there. So if this goes down again, the banks are going to take it on the chin again. And again, it'll provide an unbelievable buying opportunity. So we had a buying opportunity in July, which we did take advantage of. We're going to get an even better one in the first quarter, at some point in the first quarter of this year.
Okay. So, I mean, the first thing I want to do right now is just congratulate DX, Webb, and Raychon as well for joining here, the chat room, for joining the family. Joining the chat room here with Matt Maley. All right, so this is why I like it. This is why I like your style, Matt, because you're able to bring in the macro. You're able to make sense of the economy, what's going on, and you translate that into educated financial decisions, in which, for us as retail traders is very helpful because we don't have 40 years in the game like you have, where you've seen this before, you've seen this party play out for a long time. And I feel that the value of that and knowing how to trade around the market news. And like, I remember you came in at 8:30 in the morning or something like that to report about the CPI numbers. Like, hey guys, if the CPI number is below this, put this trade immediately. And just trading around that, I think is very helpful because a lot of retail traders are still trying to figure themselves out. What kind of trader I am? Should I do options? Should I do penny stocks? This and that. And there's safer bets, if you want to call them that, I guess, where you have a precedence of what's happened in the past. And that's the type of trade that I like, where there's actual, research and there's actual like logic into it, not just Wall Street bet kind of thing.
Right. And that's one of the things you really, again, the Wall Street bets, there's a lot of people on there that are trying to pull this pump and dump. They try to push something out there, and it causes they're not really there to help anybody else. They're trying to help themselves, and they try to push stocks up a little bit. I just want to, every time I punch in something on my camera on my computer, it kind of goes off. Sorry, I didn't want to. I was going to adjust it there, but anyway. So going back to and I hope you can still see my screen here with the what we did here. We're talking about Rodrigo talked about coming in early in the day and saying, "Hey, this is going to be a big important read." Now the market wasn't open then, of course, because the market doesn't open until 9:30. But it's like, hey, this market, especially, I came in and said this is an important move, and I couldn't believe the stock futures didn't move. So I came back in at 9:20 saying, the market's going to move off this, and we made a nice call on that. Now here's a situation, same thing, middle of the day. This goes back. I had been concerned about what was going on with the Fed changing their. I felt that everything was leading up to Chairman Powell at their December meeting was going to come in and confirm that they indeed are going to accelerate their cutting back on QE, and that they are going to raise interest rates earlier than people have been saying. Remember, people were thinking September, and then by then they were saying June, but then some people were starting to throw March in there and all this. And so this, I thought was I was worried it was going to be negative for the market. The problem was, though, that the stock had sold off that week earlier in that week, and we made some money in both the SPY and QQQ puts. However, as we came in, and I worried about that, I said, we're set up for him to confirm it. Everybody's, too many people are saying that he's going to. Some people are saying he's going to back off and try to smooth things out, but I don't think he's going to do that, and I think the market's already priced that in. So we came in. Sure enough, here is when they came in, the QQQ, when he came in and the Fed made their announcement, okay? And this is when, I'm sorry, take it back. I was worried about the announcement actually came here at 2:00, okay? Then at 2:30, he made his press conference. But right in here at 1:30, I said, you know something, guys and gals, this thing is already priced in. People are too short All right, I looked at the put call ratio. I looked at some of my sentiment reasons, especially versus futures traders. And I said, let's go in and buy and hedge. We had bought some puts, made some money there. Let's take profits on most of our puts. We can hold a small amount and just in case, and then we'll buy some calls. Look what happened and then I said, let's hold on to them. At the end of the day, saying, oh, look how much they're up. I said, no, we'll see upside follow through. Literally on the opening, I said, before the opening, I said at 9:25, I said, let's take profits on this. Now, if you got it the exact tick to the upside, you got 360% in 2 hours of trading, 2.5 hours of trading. Now, I readily admit that for most people, it might have taken a few minutes, so they only made 340% or 300%. But there was a huge move that we made middle of the day that worked out very, very well. These are the types of things that, a lot of them aren't a lot of them, my best call I've ever made was on Viacom, and it's I can go back and look at the chart here. Here it is, Viacom. This was my best call ever. Now this was, and it happened quicker than I thought it would. It happened just over like 2 or 3 days, two days. But what happened was, again, combining fundamental and technical research. Fundamental, love the company. It's a great company. But they're meme stock. I mean, what's meme about Viacom? It did have a high short interest, and it was only being pushed up. Look at this. Was this weekly RSI? Okay, look how many times when it got overbought, the stock sure enough came down, going back a full decade. It just kept going up and up and up. He's got a 93. It's RSI. It's relative strength. Let me just go just for educational purposes. See this red line? That's what they call the 70. Level, green line's at 30, red line is stop. Okay, it's getting overbought. So that's why I have a red line. If it gets above 70, it's getting overbought. Be careful. And if it gets way above 70, you want to sell it or even make a negative bet. Below 30, let's go buy. That's why it's green. It's go thing. And of course, when it gets extremely oversold, it becomes now like so many other things did at the bottom of during the pandemic. They became way oversold, and that's why So Viacom is like, well, what the heck happened there? Well, it happened to you look at almost every stock in March of 2020. That's what its chart looked like, because everybody was scared to death, and rightfully so. But this was just made no sense. Finally, I said, okay, I got to 93. I've been watching it for several weeks. And I just said, okay, this is ridiculous. We're going to go in and we're going to load up, pounding the table. We got to buy the put option on this stock. And sure enough, within 2 days, we made 2,500%. Okay. And some guys, I said, we can't 2,500%. Look at what the stock did. It's crazy. Went straight down. Some people even held on, made over 10,000%. I wish I could take credit for that, because hold on, it's going to fall further. I didn't get greedy. Some people, and what I do suggest sometimes, say, hey, you're up 2,500%. Let's sell half your position, or let's sell 3/4 of your position, or at least 20% of your position, whatever. Then you can play around with the rest, because then obviously if you sell half your, if an option goes up or anything goes up 100%, you sell half of it, you've already covered your costs. You cannot lose money, period. So when it goes up 2,500%, you sell half. You've already guaranteed a huge gain, and everything else is gravy. So I wish I could say this is something we get every single month, or even every single year. But these are the types of things that we look for. It's not just short-term ones like we got in the QQQ in the middle of December, and we got some the following week as well in the put options. And the SPY and some of these index options. Last week was a little bit quieter. We had some nice calls there too, but of course with the holiday week and the market's really thin, it was a little bit harder to play. But that's really what oops, I wanted to go back to this. That's really what we wanted to play. The other thing, just while we're on here now, just because I know a lot of people care about it, talk about it. Again, this is going to be a little bit more of an educational thing, but my view on Bitcoin, and I've been bullish Bitcoin long term for a while. I did turn more cautious up in here. I had some good calls in here in particular. I got very cautious, but then when it held the 30,000 level, especially when it broke 40,000, I got really bullish, backing up with really back up the truck. Doubled down when it held 40,000 again in September and had a nice rally. Now, again, only because it became overbought, I became a little bit concerned. But again, this is on a trading basis. I still like it long term. I still like it intermediate term. One of the things that I'm worried about, of course, is a lot of these assets. I talked about this before when we talked about Tesla. A lot of these assets have become way too extended because of that excess liquidity, emergency level of liquidity that was provided by the Fed long after the emergency was over. I mean, you look. Let's go back to the beginning of 2020. This is a Bloomberg machine, by the way. This is what I'm using. But see what happened here? Now, even though the Fed came in March, okay, it did rally nicely. It doesn't look like much but on a percentage basis, it was a huge rally. It went from 4,000 to 11. So it more than doubled, okay? But then it went parabolic. Why? Well, wait a minute, Maley. You said that this is the Fed. Well, what happened here was that the Fed was providing liquidity to artificially hold things up because the economy just shut down, okay? And then what happened here is that even as things started to normalize and there's rumors about vaccines coming by the end of the year and stuff like that, suddenly then especially as we moved into the end of the year and the vaccines became available, the emergency was over, and yet the Fed was still providing emergency liquidity. So it went into the stocks and assets that were really flying. And so I think it got out of hand here. And that's one of the reasons why I turned a little bit cautious in the middle of the year this year. However, so I'm worried that this time it's going to be a problem because not only is the Fed, now I'm worried that the Fed has pulled back, is going, with them going from massive amounts of liquidity to zero by March, some of these assets that ran up just like they did here are going to fall out of favor and come back to something that's a little bit more realistic. The thing is, Bitcoin's already had that move, right? Obviously Bitcoin is a lot more volatile name. The stock market kept chugging. When Bitcoin got hit here, the stock market kept rallying nicely. But Bitcoin is now, I think it's 25%. I'm not read it's 30%. Hold on. Yeah, 32% below its highs. So it's already worked off some of that froth. Now, what my feeling, and I'm not pounding the table on this, but I think there's a real good chance that Bitcoin and Ethereum especially will do very, very well in the new year. Again, it may take a couple of weeks before this to happen, but this is what I think is happening. Remember, even though Bitcoin, I just use this as the base, Ethereum had a better year, much better year, and it's the one I like best. But just because Bitcoin is the best known one, it's still well up on the year, okay? It was still up, it's here 70% or so on the year. I'm sorry, 30, let's just move it here. It still had, even though it's 30% off its highs, see where see there, still, yeah, I was right, 70%. Still up 70% on the year. And people are saying, well, so why would, I understand, why maybe people like to sell their losers, take, tax losses because they can work them against their gains, et cetera, et cetera. But we also have a situation where institutions, they like to have their winners doing really well at the end of the year, and they like to get rid of their dogs, the ones that haven't done well. Well, why would institutions do that here? It was up 71%, even though it's down. They still had a great ride this year. But remember this time last year, everybody was talking about how the institutions hadn't got into the cryptocurrencies yet. And that was true. They all started getting in. We really heard a lot about it in the spring and early summer. Well, guess what? Where it was in spring and early summer, up here. Okay. So they're actually even or down. Okay. Plus, even though they're finally getting in, it was still a very, very small part of their portfolio. So what do they do? What institutions do at the end of the year, they refer to this as window dressing, and they try to dress up their portfolios. They do it actually at the end of every quarter sometimes, and they're restricted on what they can do and can't do, but it's not specific rules. But in other words, what they try to do is push up their favorite stocks, the stocks with their biggest holdings, and push them, really buy the heck out of them in the last 2 days of the quarter, or last 2 days of the year, or last few days of the year, so they can get it as high as they can, so their performance is as good as it can be. Obviously, it helps their bonus. If they're having a bad year, it helps them keep their job. It helps them with their marketing team to help market their portfolio, maybe be a mutual fund, or say, hey, we had this great return this year. And if you're up 29%, or this year, say you're beating the market, you're up 24.7%, 25% sounds better. So how can I get up? But there's only a couple days left. There's only so much I can do. I've got a huge portfolio. Well, I own a boatload of Apple. If I get Apple a little bit higher, that will get me over. If I buy Bitcoin, it's 3% of my portfolio. That's not going to make any difference. I have a $100 billion portfolio. So this is, in my opinion, and talking to, and again, talking to institutions, institutional customers, at military, what are they doing? What are they seeing? And this theory seems to be playing out. That what happened is these guys they don't get a lot of money in at the end of the year, especially mutual funds. They get in January, they tend to get a lot of money in. So what do? If they want to push their stocks higher, they'll put the new money into the Microsofts and the Apples and the Nvidias, the ones that have been really working, and they'll avoid and they'll just get rid of, and they'll get rid of the ones the ones that have been really bad. They just want to get them off. They don't even show that they were on their portfolio. They get rid of them. But since they don't have a lot of money coming in, they sell. So they also, that's where their source of cash is, to buy those Apples and Microsofts of the world. So in my belief, I think these, and again, talking to institutions, I think that they kind of confirm this is what's been going on. They've been selling. The reason why it hasn't been able to bounce back, it sold off for not nothing to do with institutions, but the fact that it wasn't able to bounce back in December because institutions finally said, it's not working this year. I like it long term. I bought into the asset class, but it's such a tiny part of my portfolio right now, and it's never going to, well, never. It's going to be a long while before it becomes a big part of my portfolio. And I'm actually down on the year, only up slightly because I didn't start buying it until March or April or May or June, whatever. I'm out of it. I'm going to sell those and buy, and I've got a huge position in Apple. I want to try to see if I can push that higher and really help my performance. And so that, I think, now that we're moving into the new year, and again, of course, the fact that it's gone flat means the individual investor hasn't been, because there hasn't been any momentum behind it, hasn't been jumping on the bandwagon either. So it's been stuck in this sideways range, which it was in here, right, for even longer period. If it can finally break out, especially above that kind of 54,000 level, and break out of that, man, that would take it above its trend line. Let's just go in here. Especially because we don't know what exactly, what is the real fundamental value of Bitcoin. Nobody's completely sure because there's a lot of speculation on how important it'll be. But so technical analysis is vitally important there. But look at this. See, it's already it broke above its trend line. Okay, went back down, tested it. Now it's trying to go back up. If it can make a new high again above this kind of 54,000 range, it'll regain that momentum, and the individuals will start coming back in. And then some of the institutions, again, a lot of institutions own a lot of it, especially hedge funds. But the mutual funds, insurance companies, banks, these guys will say, "Oh, it's going back up. I've got to get back in." And they're going from, I went from whatever 3% of my portfolio or 2% or 5%, whatever percent. And I went to zero, almost zero. I've got to get at least up to 2 or 3% or whatever it happens to be. And when this thing is just going to take off. So keep close eye on it. Not ready to jump in yet because it may take a little while before this thing to take off. I'm still worried that as the Fed pulls in their liquidity, the froth will come out of the marketplace. But I do think a lot of that froth has already been taken out by this sideways move. A lot of that leverage has come out. So look for this upside, but I'm looking at that 54,000 level. We break above that, you're going to get a lot more comfortable looking at those. But again, we also have a Bitcoin, Ethereum. But do remember the other thing, and I do try to talk about, you got to get the winners, okay? Ethereum is my favorite because it's not just store of value. I mean, it's currency, whatever they have. The blockchain is just really good. That I think they have a lot more upside potential. But the thing is, we are not. It's just like the internet stocks of 1999. Most of them went out of business. Okay, these cryptocurrencies, we're not going to have hundreds of cryptocurrencies. We're not going to have 10 cryptocurrencies. We're just gonna have a few of them. So you got to make sure that you're betting on the ones that are going to win, not just any. Those high. Again, nothing wrong with taking a flyer on Dogecoin or one of these others, but and one of those ones will be a huge winner. But pick that right one because eventually, just like it was automobiles, there were like 50 automobile companies in 1925. It was 3. 10 years later. So just just keep that in mind as well. But I do like the potential for Bitcoin as we move into the new year. It may not be until February or middle of January, but once those institutions start moving back in, this thing's going to move back up.
Interesting analysis there. Let me just get to the chat here really quick, Matt. In the YouTube chat, Devin, yes, the calls are going to voicemail because we're doing the session here, but go ahead and join. Only the first 10 people will get a laptop. I put the checkout in the chat. Feel free to reach out, email, and I'll get back to you when we're done. Someone's asking here on the Zoom call, Matt, is your offer a full day live trading room? Well, Matt, I think you're the best one here to explain it because I know you're always, giving them more things. And how would you describe it to somebody who's trying to join right now, the chat room and the sessions that you do there every week and everything?
Yeah, we do. So what we do just on a regular basis is I try to set up a thing on Sunday. Again, it depends on the week and how much really going on that week. But I really try to get the set up the week with what's coming. Like for instance, this week we're going to get an unemployment number on Friday. That could be a market mover. If we have Fed speaking, a Fed member speaking, an important Fed member speaking, a Fed meeting, if we have the president giving us et cetera, important obviously earnings reports that may be coming out that week. Of course, we always get surprises, but a couple of things that are coming up, and then also try a couple of things on the technical side. If we're seeing, especially on the macro side, if we're seeing something going on the dollar that looks like, if it breaks this level, it's going to be, it's going to be really positive or really negative, whatever it happens to be. We try to do that. So try to set that up as kind of a week in the preview for the week. After that, we go in and it's kind of wide open between 9:30 and 4:15. I'm sorry, 9:15 and 4:15. But as Rodrigo said, I get in there. I get obvious early in the morning, and if there's anything pertinent, we'll throw it right up there at any time, 6:30, 7, 8, whatever might happen to be. And then after the day is done, it's kind of this time. Sometimes I'll throw things in as late as 5 o'clock. Overnight, if something happens, I'll certainly, we haven't really had that recently, but we certainly can. And I'm sure we will in the months and years to come, have things in the middle, in the middle of the night. I'll hop right on the chat and say, oh, did you see this? Even if you can't really act on it, at least be aware of it now so you can set yourself up. But then we talk throughout the day. And a lot, again, I'll talk about eyes. Hey, I like this idea, this stock, for whatever, the fundamentals, the technicals, the positioning is setting up for a nice breakout here or a bad breakdown. Let's look at the XYZ $30, the January 21st $30 puts. I like these right here. We'll use a tight stop, whatever it might happen to be, we'll add to that. And but I also so I'm talking about that all the time. I talk a lot, usually on the index ones as well, the QQQ and the IWM and the SPY. And then, we do tend to concentrate on the most popular stocks, but the whole idea is to show ones that aren't so popular. Constantly, let's say right here, Microsoft. I've talked about Microsoft a bunch of times. One of my other concerns about the stock market next year is that Microsoft has, Nadella, an unbelievable CEO. He sold half of his stock, $285 million, right around Thanksgiving, just before Thanksgiving. You don't sell that much stock of your own company, okay, unless you're worried that it's not going to go higher for a while, okay? And it's not because he is not doing anything unethical, remotely unethical. Every once in a while you'll see an insider, they sell a boatload of stock, and then we find out they've been cheating. They've been cheating on their accounting. I've been doing or they sold their stock because they knew they were going to lose a big contract. This is not the case. This guy has turned around Microsoft. Microsoft was an unbelievable company in the when Bill Gates was running it. It became a very kind of dead money for several years. Nadella came in. He's done an unbelievable job. It's an unbelievable company with unbelievable prospects, but the stock is very expensive. And as I mentioned before, like with Amazon, Apple, all these stocks have had deep corrections over the years. Is one coming now? All I know is when the smart guy, when the insider sells a full half of his position, he's not doing that. And they said tax reasons, Washington state taxes, capital gains are going up 7%. Okay. Well, the last 9 years, the average return for Microsoft is 30%. Okay. The worst year is 12%. So if he does as well as his worst year of the last 9 years, he'll still be up 12%. He'll more than make up that 7% rise in capital gains tax. He's smart. Guys like insiders don't sell in that kind of size unless they really feel, again, unless they know something. In this case, I think he believes, don't fight the Fed. I'm going to take some money off the table. He still owns a boatload of stock. And again, he's no scumbag. That's the scumbags are the ones who sell because they have inside information that nobody else knows. He's just like, I see what's going on. The valuation is too high. The Fed is changing things. The Fed is changing their position. We still have COVID. I'm gonna pull some money off a big chunk of money off the table. Look what companies do when really smart people, insiders, what they do. Goldman Sachs, same thing. They're partners. They had been a partnership for 100 years. Okay, they're partners. In 1999, decided to go public, to sell their shares to the public. Each one of them kept a lot of shares, just like Nadella did, but they went public in 1999. What happened in 2000? The market, the bubble popped. They saw this. They're the smartest people on Wall Street. They saw this coming. They sold. Okay, Blackstone, not BlackRock, Blackstone, the big private equity firm. Unbelievably smart people. One of the best, if not the best, in private equity. They've been a private company for 25 years. But in the summer of 2007, they went public. They sold their shares to the public, kept plenty of shares for themselves, just like Nadella has. Yet they said, why? Well, what happened 2 months later? The stock market topped in 2007, and the whole thing imploded. See, the smart guys, they saw what was coming. Glencore is one of the biggest commodities traders in the business. Same thing. They went public. Spring of 2011. 2 months later, what happened? Major top in commodity markets, and commodities markets went through a bear market that just ended, went for the next 7 years, 7, 8, 9 years almost, really, and it's starting to come back now. But again, they saw what was going on. They saw this can't last. Commodities had that huge rally shortly after the first year or two of the after the crisis, and they knew it couldn't last, and it rolled back over. And I go on and on, but they also say about Sam Zell. I mean, he sold it. It was a private transaction. He didn't go public, but he sold his company, a real estate company, just before the top in real estate. He's one of the smartest real estate investors ever. And then people say, well, wait a minute, Matt. What about Microsoft? Bill Gates, they went public, and the stock went straight up for 15 more years. And like, well, yes, but Bill Gates didn't sell on that IPO. He only sold $1 million worth of stock. And I joke and say, the only reason he did that, he was still living in his parents' garage. He wanted to have a little cash on hand. And he said publicly, I'm selling small. The reason why I'm selling so small, I want to buy. This is a great opportunity. The people who wanted to sell when they went public were their venture capital guys, their investors, okay? Not the insiders. The insiders all held on to the stock. I mean, their secretaries, we've all heard the stories about the secretaries that made $20 million because Bill Gates came in and said, you've been with us all this time. We're going public. Don't sell your shares. We're going higher. And they did very, very well. So again, just because the company goes, there's a lot of good reasons for companies to go public, and it doesn't mean their stock is going to go down immediately. They need more money to grow the business, et cetera. But when companies that have been been private for a long time, decide they want to sell, a guy like Nadella, who's owned all this stock for that many years, decides he wants to sell half. That tells you something. I got off on a tangent there. But what we're talking about here is that so we're talking all day long about these things, and a lot of people come up with all right, Matt, what do you think about this? I've owned this stock for several years. What do you think? Should I buy some calls? Should I buy some puts to hedge myself a little bit here? And or a stock that, I'm going to say a stock I've never heard of. There have been ones I've heard of them, but I don't know anything about them. So what do you think of this? And I go, well, I don't know anything about this company, to be perfectly honest with you. I know what business they're in, but I do see on the chart, this is what's going on. So, this is more probable, but I can't, I don't pretend to know everything. And I certainly can't, people can't come in every day and give me, a list of 20 stocks. I wouldn't have any time to do anything else. So but point is, people are constantly, I'm showing ideas. The people on the chat room are showing their ideas, asking for my opinion on something that they may have an idea. They're just like, hey, I've been looking at this. Looks like it wants to break out. Looks like it wants to break down. They may have no position in it, and we talk about it. And we talk about it again. And we talk a lot about it, especially when it's very short-term trade involved. We do the We look at a lot about the technical analysis, and then we also do every Tuesday. I do a webinar, and at 11:30, and I try to make it. I usually try to start off with a little educational thing where we talk about a certain aspect of technical analysis. So we'll talk about a head and shoulders pattern, ascending triangles, wedges, things like that. Only be one, and we'll kind of talk about that, give people an idea what's going on there, and then we'll go into some of the more details on the calls that I'm making, or on call, because there's sometimes. Just last week there was a couple of them there, and one guy in particular came in with this, and I said, "Wow, great catch! I didn't see that at all," and told him why I thought agreed with him, and backed up, gave him more confidence. And it wasn't I totally tell you, it wasn't my idea, but people made in just several hours made anywhere from 50 to 70%, depending on where they bought and sold the option. Made some nice money, and I readily admit I'm not. Why would I take credit for something that somebody else had? And so that's what we're constantly doing, working, feeding off each other, and it works out really well.
It's teamwork. Absolutely. I mean, it's like 200, 100 eyeballs is because somebody can look at something on like the two minute time frame, and you might have not checked that out, right? So, exactly. And the other thing that I really want to notate, and it's really not like, I mean, if you wouldn't have brought it up, really most people would not know that, like, if you're watching a general news place, talking about stocks, that, it's their job to be bullish, right? And not give you, I guess, the honest approach that you would take. And, a lot of the retail traders, what they've told me is that they do appreciate your honesty when it comes to reviewing a stock, doing a full analysis, not just, the bandwagon trade. Yeah, it's going up forever. Instead, actually trading around, the dips and the rips both together.
Right. I mean, it's so true. I mean, and I go back to that Amazon example. I mean, if you were the analyst in Amazon, now, of course, the stock has been going kind of in a sideways range for a year now, over a year. But if you were the guy in Amazon and said, I'm bullish on had a buy rating on it for the last 25 years, you've been spot on. Nobody's going to criticize you at all. And I should do that. And for that kind of, if you've been an analyst at, Bank of America or Morgan Stanley, Goldman Sachs, whatever, that's their job. Their job isn't to tell you what's going to happen over the very near term. But sometimes they'll say, yeah, it's getting a little expensive here. It may need to pull back, but I'd buy more on weakness. And that's fine. That's what they do, because they're talking to people they're only referring to that 3, 5, really 5 to 10 year time horizon. They're not looking at all at anything shorter, even 1 year. Forget about several months. And I'm just going to go back. I'm sorry, I had the presentation I was going to do, but that just gets monotone and gets boring for you guys. But I'm going to go back to my presentation here. Let's see if I can find the one I want to show you. Is what we try to do, and one that I really, as I talked about how I really like the energy stocks, right? And what did I do here? Here it is. Right here. Is this it? Nope. Okay. I'm sorry here. Just give me 2 more seconds if I can find it. There it is. There it is. Okay. Now I'm going to put it on the slide so you can see it much better. Okay. Now, this chart's a couple months old, but I mean, I loved, as I told you about why I like the energy stocks back in September, October of last year. I was really like the group. They were under-owned. They were oversold. They were over-shorted. The positioning was really, really short. And on the fundamental side, we all want to get away from fossil fuels. I'm not saying, I'm not saying don't believe in climate change, anything like that. I'm saying this is reality. We're not talking about theory. My job is not to tell you what should happen. What I tell you is happening and is very likely going to happen. And we are not going to get away from fossil fuels in the next few years. It's going to take decades. And you will look at the IEA, the International Energy Association, okay? They say demand for fossil fuels can remain within 5% of pre-pandemic levels through this entire decade, okay? Again, the Saudis are saying the same thing. Now, of course, the Saudis are talking their own book, and I understand that they wanted to move that way. But we can still trade around these. This is what I try to do, okay? So remember, I mentioned how I really liked the energy stocks here in that time frame. Now they went sideways for a little bit and actually went down, but I still hold on to that fact. Then they took off in November. Okay, but they had become so oversold. Again, I was using that fundamental analysis that I talked about, the RSI, which is relative strength index. Remember, when it gets below 30, it's a buying opportunity. And so this would be a great buying opportunity. It's a little early, but it came back down and retested that level on the the buy side level on its RSI, its relative strength index. And I started pounding the table. Well, sure enough, the thing took off. Then it became overbought. People are saying, "Ooh, should we sell it right here?" And I said, "No. Don't sell it, because it is experiencing a golden cross." Remember when that rising 50-day moving average crossed above a rising, just barely rising, but just started to rise, a 200-day moving average. So instead of selling here when it was getting overbought, I doubled down and said, let's really get into this thing. And up here, now we get early in the new year. It was funny because then finally the bulge bracket firms started turning bullish, even though they had missed a huge part of the move. And there's nothing wrong. We all miss moves, and there's nothing wrong with being late to a move. I mean, you'd rather be earlier. But there were some firms that literally didn't turn bullish until basically here in March. Was it a couple of them like BMO and Schwab? They didn't turn bullish to here. And I was saying take profits. But again, it did get overbought. Okay, it was overbought again, but it wasn't getting into these golden crosses. So I said, let's take our positions, cut them in half, and buy some put options on the XLE or the XOP, which is the energy, oil and gas, energy and exploration ETF. Okay. Then it came down here. It came back down to its 50-day moving average. And I said, okay, let's take our profits on the options. Let's buy back, get back in the thing. Again, I was a little early. It did take one more dip, but take back up again. Again, it got way up in here. Now, this got overbought. Not as overbought here, but the positioning, I looked at the futures positions and the commitment of traders data showed that people were getting long on the short-term traders, the futures guys, were getting short on a long-term, we're getting too long on a short-term basis. So again, take profits there and buy a few put options. And again, back in here, I didn't get the exact bottom, okay, but let's go back to a full position. And of course, I'm bullish again here. And again, this only goes until October. It's an old chart that I had for a different presentation. But my point is that we're constantly looking at situations. Those, and again, for that bucket that you have for that long-term trading, this is not what you look at. Say, I was wildly bullish on on Chevron here, pounding the table, and I said because it had a 7% yield, the stock it had a huge year, and the thing is, it's like my mother. I always laugh. My mother, who actually was a very good investor. It's funny. She had some money set aside and she invested it. And my father just used to say, he says, you wouldn't believe how well she does. He's like, and it wasn't a huge amount of money, but it did very, very well. But she still, certain things she didn't quite understand. And one of the times she had bought a stock and she said, oh, the yield's gone down. The yield's gone down. And I'm like, no, Mom, what are you talking about? You bought the stock at $30. Now it's $45. You're doing great. Yeah, but the yield's gone down. I'm like, well, Mom, the yield has gone down. They're still paying the same dividend. The yield's gone down for the people who are buying it now. She's like, oh, in the Wall Street Journal, it says the yield is, you're still getting that 7% yield because you already own it now. And it's like, oh, it took her a while to she was in her 80s and she God bless her soul. She's passed away, but she had a great lady, and I love her very much. And it was just so funny how, even though she was very, very smart with just seeing common sense ideas, but there were certain things that she didn't understand. But the point is that for people like that, or just long term, you don't have to worry about that. You should just hold on and just, and so when the stock got up to here, Chevron, when it was up here and Chevron was doing really well, I said, well, you can take a little profits in Chevron, but we still like that. It was one of my tier 1 picks, or the long-term picks. I said, let's just let it run. Okay. And we're going to let that run for a while. As I mentioned, I still think they've got more upside, and Chevron's the best company in the business. Great team. And they are making these changes, like most companies are. They are changing from the fossil fuels, but they realize that they have to stay with it to a certain degree because the world needs it. I'm not going to get political here. I mean, again, what my political stance on things, I try to be neutral anyway, but who cares what I think of what Trump did or what Biden did? But Biden did cut back, and we've had a significant cutback on capital spending, on pulling oil out of the ground. We cannot turn a switch and start pumping out a lot more oil what we could have in years past. That's just a fact. It's environmentally, that's good. Economically, maybe not so good. Short term, it's going to cost, it's going to mean the supply is just not going to be as strong. And when I talk about the demand, the IEA is looking for demand to be within 5% of pre-pandemic levels for the 8 years. Okay, and if we can't pull it out of the ground, even though the Saudis are going to produce some more, Russia, whatever, the ability to produce it to meet to the degree that it'll be enough to meet demand is not there. Like it or not, it's just what it is right now. It'll be, again, things could change. Some could definitely happen. War, whatever might happen, could shut that down, could change things significantly. But we could have a big recession and demand falls off a cliff, and so oil prices will come down, et cetera. But right now, it looks very good. Now, the other thing I want to say, though, too, when it comes to inflation, and I'm going off to a sidetrack here, but the thing that we have to worry about with inflation is the Fed wants inflation. The Fed needs inflation. Before, they kind of wanted it, they want to get up to 2%. They won't say this, but they want more than 2% inflation. So get used to it. And so why do I say that? It's like, for the reason that we are in a debt bubble. I mean, corporate debt, this time last year, everybody was talking about how we were in a corporate debt bubble. Well, guess what? They've issued a gazillion more dollars in debt. We're up to $11 trillion of U.S. corporate debt, $1 trillion, okay? It's ridiculous. There are two ways to get out of a debt bubble: massive bankruptcy, or massive failure, or inflate your way out. Massive failure is not going to work, okay? So the Fed has got to take the lesser of two evils. They've got to help inflate their way. Because people keep saying the Fed can't raise rates too much because it'll raise all our costs and the cost of the government trying to borrow. That's true. They can't go back up to 8, 10%. But they have to go a little bit higher because these corporations will never be able to pay off all this debt. They'll keep rolling it and rolling it. It has to inflate. The debt they have on has to become lower than their income, and you do that through inflation. So look for inflation to see it'll go up and down, raise and around. But those people who think there are some cases we had a tech bubble in 2000 in 2000, of course, and it burst. And we went to a little bit. It wasn't even really a recession, but the stock market got crushed. A lot of people lost a lot of money, but the economy was fine. Okay, the economy held up fine, and that was, we had to experience a bunch of pain to get that froth out of the marketplace and move on. You can't have that when you have a bubble in the bond market, the corporate bond market, because if all those companies go out of business, you're just wiping out too many people. It defaults, massive default. Everybody, defaults are part of capitalism and they're important. But to get the massive kind of defaults that would have to take place to get rid of this bubble, it doesn't work. So they have to inflate their way out. So inflation is going to stay for the rest of this decade, in my opinion. And it's something the Fed not only wants to do, they pretty much have to do. Now, they'll fight inflation, and that means higher interest rates. But they want inflation to a certain degree. So keep that in mind when people are telling you not to buy commodity-based stocks. I think that they're going to do very well for a long time, many years.
Okay, and we've been following this theme, Matt, for a while. Well, just seeing what's happening in China with the real estate sector there. Considering everything that's happening with Omicron there, do you think how much more worse could it get, and could that spill over? Because I think we've been talking about this possibly spilling over, but it's kind of been kept afloat. What have you found out about that? Where are you with that?
Well, it was funny you mentioned that. I even wrote this down today. It was funny. I wasn't really doing it for here, but I just by chance, wasn't expecting to talk about this, but I wrote down: China real estate developers have $197 billion they need to pay out in January. Okay, this is money for bonds that are maturing, coupon payments, and wages. I mean, they have to pay $173 billion in wages and back wages in January, not in 2022, in January. So to think that Evergrande was the only problem in China is crazy. Now that China did the right thing, it was getting out of control. They needed to do this, but to think, and we do already know that there were several others that had problems when Evergrande, they had they've faced some problems. The smaller ones are big trouble. They're not going to be, again, that may not be create systemic issues, but they're definitely going to create problems there. And that's the thing. It goes back to what we said a little bit earlier, how China, remember this time last year, or about November, Alibaba went under. I'm sorry, Alibaba did go under. That's ridiculous. But Alibaba, Jack Ma, he was out. He basically disappeared, and the stock got hit. And they clamped down on Alibaba, and everybody was thinking, well, this is just Jack Ma getting too big for his britches, and he was shouting off. So they needed to, whack him in the knees to just get him to calm down. But then all of a sudden they came out and they started going after Evergrande, and they went after these real estate companies. Then they went after more technology companies. Then they went after the education companies. Then they went after the gaming companies. Then they went after the video game companies. And it's like in between each time they said, "Oh no, we're not going to be that bad." And then more recently they had the head of enforcement basically saying, "We're just in the early innings of enforcing this stuff. Just in the early innings of enforcing monopolistic behavior." And this is just literally a couple of weeks ago. So this isn't going away. China is believe me, and people saying they don't want their companies to go out of business. They still want to. There's something in between. Just because nobody's saying that they want Alibaba to go out of business. They only saying Tencent wants to go out of business. Nobody says they want to ruin their real estate business, their real estate industry. No, but they can't. But they don't want them to have what they had. Because the government is communist government will lose control, okay, and so there's going to be something in between, and so will it spill over into here? It certainly, I think it will because again when they're clamping down on this risk taking, on this leverage, on the debt, it has to happen. We see what's going on with Evergrande, and it will happen to other ones. We see what's going to happen this month with the amount of money. How are they going to come up with all this money? I'm not really sure, and maybe the government will come in at the last second and give them a little bit, but we are not going back to those days. And that's why trying to catch a falling knife on these China stocks is not what I want to do. I don't know that they're going to go a lot lower. I mean, I'm worried about the real estate situation in China and having more effects because it just things like that. It's not just one or two companies. The one or two big companies go down. A lot of others have problems as well, as we learned, of course, in the banking crisis of 2008 here in the U.S. But what I am saying, and again, and I might be wrong. Maybe we are seeing something like Alibaba. Maybe this is the low. JD, another one. Is this one where we've seen the lows for these stocks? Maybe, but given that they're kind of the boy who cried wolf. Every once in a while they say, "Oh, it's going to be okay. We're going to ease off," and then they put the hammer back down again. I would rather when the rally comes, it's going to be a huge one. I don't mind missing the first 5 or 10%. To be sure, again, to be sure that it's actually taking place, rather than get hammered. Like, again, most people, everybody did really, really well in most stocks when they bought them on dip in the U.S. this year. Not so much in China. Those who bought on the dip got absolutely hammered, and that's one of the reasons I think we saw at the end of the year. Again, they may bounce back. These bounce back kind of like my argument on Bitcoin, bounce back a little bit because people are saying, I just want to get rid of my losers, and a lot of these Chinese stocks were the losers, and maybe they will do a little bottom fishing early in the year. But to really give them the great upside momentum that they had before, and I don't know that we'll ever get quite back to that, but they could still be great companies and are great companies, but can still be great stocks. But again, given the political backdrop, I'm going to have to hold off and wait till I get the confirmation that we need to really jump back in. So that's another headwind, again for the overall market. And it's the thing is the stock market, since we got so far ahead of when I talked earlier about how the market's at almost 22 times earnings and more than 3 times sales, that even if the economy improves or holds up, it'll be hard. If the market comes down, the economy will have some problem. Well, at least face some slowing. But the point is, when it gets that far ahead of it, okay, usually the stock market we have to see signs that the economy is actually going to roll into recession before you start worrying about a severe drop in the stock market. We don't need that this time because the economy is not the reason the stock market's where it is. Okay, when the stock market when the economy is flying and doing really, really well, and the stock market gets really, really frothy, okay, then it's the economy that they're pricing in. They forward price it in. Now they're pricing in the artificial. Again, it wasn't the entire rally, but even most of the rally. The economy has gotten better, so the rally from the March 2020 lows has been legitimate. It's just that it's went way, way too far. And the reason that it went way too far is disappearing as we speak, and will be over the next few months. And therefore, this has to come down again, even if the economy's going okay. We got to find that thing. It's don't fight the Fed. Why these permanent bulls? Where are they? Why aren't they saying don't fight the Fed anymore? Why? Because it doesn't fit their bullish narrative. But it's something we have to worry about. This is not the one thing I will say though too, is that the last two bear markets were big bear markets. And so people, when I started to say, oh gosh, this is going to be a problem. Well, that guy must be calling. Oh my gosh, he must be looking for another 50%. No. And again, even whether we're heading for a bear market or not is a whole different situation. I think we have a deep correction, and maybe even turns into a bear market. But most bear markets are in that 20 to 30% decline, kind of gradual, kind of run of the mill. And and again, I think the Fed will, if the things get that bad, the Fed will have to come in, because if it gets down too much more, like it did in 2020, when it got down 35%, they had to come in because the declining stock market was starting to spill over into the credit markets and the economy. The credit markets. So I think that if it does get that deep, they'll come in and try to support things. However, I guess my point is, embrace it. Be the person. Corrections are normal and healthy. We just haven't had one in so long that people have kind of forgotten. They're normal, they're healthy, they provide opportunities. We want to be raising a little bit of cash, taking advantage of downside swings, because what happens if we do get a decline, look what happens. We had 2 5% declines, or not even 5%, one 5% decline and two others that were high 4% declines. Everybody was saying, oh my God, is this the beginning of a crash? It's like, that's barely a blip on the radar. In 2012, nobody even thought twice about it, because we just come out of this huge bear market recession. So when it gets down 15%, think how panicked people are going to be. Well, if you're in 100% cash, or if you're leveraged, if you're 100% stocks and you're leveraged, and you have no hedges and no cash on the sidelines, you're going to panic too. If you're leveraged, you're going to get margin calls. That's why the worst part of market declines. No, markets never crash from the top. I suppose if there was a nuclear explosion, maybe something like that. But the reason why is that the only thing that causes crashes and those kind of severe things, like we saw in March of 2020, is forced selling. Okay, the market goes down, goes down, goes down, goes down, goes down. But people, they don't get a margin call if their stock is down 7%. And suddenly a stock gets down, 12 or 15%, which means their worst stocks are down 30%. Then they get the margin call, and they have to sell no matter what they want to do. They have to sell. And that takes that market, that exit. And those who are like going, oh my God, even if they're not leveraged and aren't getting margin calls, are like, holy crap, holy, you know what? I got to get out. I got to sell some more stocks. I should have sold earlier. I'm got to get out. And they're panicking at the exact wrong time. But those of us who have a little cash on the sidelines and have made some money are going to be the ones sitting pretty, saying, yep, bring it in. It's like, trading places. Buy them back. And if you've never seen Trading Places, please see it. It's a hilarious movie, great movie. But it's about futures trading, and it's 25, 30 years old, but it's still a great movie. But anyway, we're going to be the ones who won't be panicking. We won't be getting margin calls, but more importantly, we won't be panicking. And even if we don't, everybody, it'll be like, oh my gosh, it's down 18%. Really? Could it go down a little bit more? You buy a little bit, and then you buy it on the way back up, and you don't mind, because it's like, something I've talked about many times in the past, and a lot of people know, heard me before. When you have owned something that's down a lot, and then you start paying up, it's like, oh man, the stock went from 40 to 20. I bought some. I should have bought a lot more. Now it's a 20. Now it's a 25. I should have bought more. It's like, well, then buy some more, okay? Because your average price is now going to be 22 and a half. I mean, load up at 25 because it's ridiculously sold out. It's ridiculously cheap. It's been washed out. Forced selling is knocked way down below where it go. Yes, it's hard to back up because you never get the exact bottom. Don't be afraid to buy it on the way back up because you buy some at 20, you buy half at 20, buy half at 25. Your average is 22 and a half. And guess what? But it's trading at 25. You cannot lose money. You put your stop limit at 22 and a half. That's your cost. You won't lose money. Now, there's no guarantees because, of course, every once in a while something could gap lower and you could technically move money. But as it keeps rallying, suddenly it goes to now it's back to $40. Now you've moved your stop up to whatever level you want. You can take it up to 35 or even give it a little more room, give more leeway, whatever you want to do. You are guaranteed to make money. So these are the type of strategies that we talk about in the chat room that again, you got to be willing to let you got to cut your losses. These people say, geez, I lost, especially in a stock position. Options, they depending on how much you put into it, sometimes we put very small, we call a lottery ticket, say we'll just buy one and put a very small into it. And then if it, it's $50 and if we lose it all, we don't care because it's just a long shot. But for most cases, you want to keep your options to, 15, certainly 20%, but in stocks, no more than 10%. You're down more than 10%. I don't care how much you like the idea. Get out. Look for another place to get back in. If the momentum's going against it, look for another area. Do not double down when the stock's going down. Because if you buy a stock at 20 and go the other direction and buy another half at 10, okay, that's great. Your average price is 15, but the stock's trading at 10. You're just adding to a losing position. What good is, now you're just relying on hope. That doesn't work, okay? Now, again, there's nothing wrong with buying something at 20 and buying a little bit more at 19 and a half. In here, you can't get the exact bottom. But when it drops a lot, don't keep adding. Get out. And then on the ones you have, let them run. Don't be afraid to add to them as they're running, especially if they're coming off a level where they're very cheap and oversold. Mm-hmm. And then you can play it by that. Let them run. Too many people sometimes take profits on stocks too early. Well, I've doubled my money. I should sell it. I was like, well, you doubled your money, but you bought the stock when it was completely washed out. It's got great long-term prospects. The chart looks good. It's not oversold. It's not overowned. Why would you sell it? Oh, good point. Just raise your stop level, and then at least you guarantee that, if it goes down a little bit, okay, then I'm out. But I've doubled my money, so who cares if I make 90% instead of 100%? I've still done very well, and I feel good. And plus, I can let go. Maybe it's up 150%.
And I would have already been out like at 100% gain, but like for those that like to take a little bit more chances, like many of these calls and puts do end up going 200-300%. That's good. Someone's asking if it's just options, so it's stocks, options, and crypto. From what I'm understanding here, Matt, right? You're taking a look at crypto now as a chief market strategist here. That's a pretty interesting take. Good stuff there.
Yeah, we'll do it. I mean, it's like in anything. In fact, one of the things right now, and I'll go because I wanted to go back to my my Bloomberg here, is that like when we're looking at these things, if you want to play in the dollar or in the currency markets, you can do that. But I do not very, very infrequently. Once in a while, look at the UDN, which is a dollar ETF, which is looking for a down dollar, and the UUP, which is up dollar, looking for the dollar to go higher. But the dollar is going to be, but you just have to look at these currency markets. And it's what I'm doing. Well, I haven't had to recently. It's something I look at all the time, but I haven't talked about it a lot because it hasn't really been a compelling, a compelling issue. But everybody's talking about how strong the dollar's been, and it has been. But look at this. This is going to be important for commodities and for, let me get some of this, some of the lines out of the way so I'm not quite so busy. This chart doesn't look quite so busy. Okay, but look at this thing. I had a great rally from May up until here, but it's flattened out significantly. Okay, and I was looking at the COT, the COT, some people call COT or COT, commitment of traders data, and it shows that the speculators, there's what's called commercials and non-commercial traders in the future spits. The commercials, they're the ones in the business. For instance, the oil business. Every oil company has a massive trading desk. They're trading oil all the time. They're what's called commercials because they're in the business. They have people in their company telling them all the time, hey, this is going on at this basin, this drilling site now, Alaska, we know what's going on. We know how much is selling, how much is buying, how many people are buying, where's demand, where's, the supply is fading. They know what's going on. Okay. They're considered the smart money. Then they have the non-commercials, or their nickname is the speculators, or the specs, and then specs for short for speculators. And they're not in the oil business. They're just betting on whether oil will go up and down. And the real smart ones do very, very well. But they're considered the dumb money because they really don't know what's going on. And whenever, again, that's the biggest thing. When everybody gets too far to one side of the boat, no matter what the fundamental backdrop might be, it's got to go the other way. And right now, people, the speculators, the specs, are getting, it's very crowded being long the dollar. Okay. And the short position is starting to build up quite a bit for the commercials, the ones who really understand what's going on, the ones who are in the business of they're international companies. I mean, 3M. I mean, they have a big trading desk, trading currencies all the time because they have a big international business. Those are the people who are getting short the dollar. Okay, and they're not wildly extreme. It's not historic records, but it's becoming a very crowded trade. The dumb money is getting too long the dollar. Plus, the dollar is flattened out here. Okay, this is the DXY dollar index, and it's flattened out. Now it's down to the bottom end of that range. If it breaks much lower from here, okay, it's going to break again below that sideways range. That won't be good. And if it breaks below 95, it's going to break below its trend line, going back to those spring lows. And this is going to be important. This would end up, I think froze, but this will end up being an important change in trend for the dollar. Well, I said, well, wait a minute. Well, maybe I should go out and buy the UDN, and that could be, and we could buy options in the UDN. But the thing is, that's not they don't see huge percentage moves. I mean, the dollar doesn't move 20% in a day. Okay, yeah, we certainly hear that with some, we call emerging markets. Currencies can move like that frequently, but the dollar is not going to move 20% in a day. So it's not. But where do you buy? Okay, where? But what does this tell us? There is a significant inverse correlation with the dollar and commodities. And this is another reason why, if the dollar breaks down, because oil has been around, oil isn't as strong a correlation as some others are, like gold, copper. But if this thing breaks down, okay, especially if it breaks below 95, it's going to be bullish for gold. I'm sorry, bullish for oil. It's going to be really bullish for gold. It's going to be really bullish for other commodities. And again, you can look at the CRB index or whatever, but silver, gold, oil, etc. Very, very bullish. Also going to be bullish for emerging markets. And it's interesting. One of the smartest emerging markets people I know talked to recently was just saying how still concerned about China, like we talked about, but very, very bullish emerging markets ex-China. And sometimes you're like, well, wait a minute, how, like a place like Vietnam, which a lot of people are bullish on, it's like, how can you be bullish on Vietnam if one of their biggest customers, China, is having problems? Well, I understand that, but the point is, when the dollar, because most commodities are traded in dollars, and so therefore, if the dollar gets weaker, it's bullish for those commodities. It's bullish for those emerging markets, many of whom are commodity based. So this is going to be something that's very, very interesting. We're going to be watching very, very closely, even though it's outside of the stocks options. But boy, this thing breaks down. We're going to be looking at the GLD and the GDX, which is the oil miners ETF, and maybe some individual ones, but looking at some call options there. Oil, gold is already trying to rally. It's tried a couple of times here. And people keep talking about why, it's like, well, it's really not important anymore. I'm like, it's been an important hedge for inflation for 5,000 years. So maybe Bitcoin or other cryptocurrencies will replace it to a degree. It's not going away after 5,000 years. Okay, number one. Number two, it's not just an inflation play. If the dollar gets weaker, that's going to be that should be bullish for gold. And again, there's people talking about, I only care about Bitcoin. I'm not that. That's from my father and grandfather. We're about oil. It's like, I want to make money where the opportunity presents itself. Gold is getting close to a place where it's presenting an opportunity where we can make some money, at least on an intermediate term basis. If Bitcoin replaces it several years from now, what do I care if I can make money on it right now? That's exactly what I said 15 months ago in oil area. 20 years from now, we're not going to be buying fossil fuels. The fossil fuels will be disappeared, but that doesn't matter. We can still make money on these stocks right now. And they've been the best performing stock, not just for this year or for 2021, but for the basically 15, 16 months going into the end of the year when I turned really bullish on the group. So again, I don't worry about the theoretical thing and what should happen. I'm caring about what is happening. And gold, if the dollar breaks down from here, we're going to watch it. Again, that DXY dollar index, 95.50 will take it below its sideways range in about 6 weeks. That's going to be a yellow warning sign for the dollar, and a break below the trend line of 95 will turn it to a red flag. And so the way to take advantage of that, I think, is some more, and more so in the commodities, like, getting more bullish. That will lead the XLE to break above a key. That'll make another higher high and take it above its. I get so excited. I love the markets. I get really passionate about it. I'm sorry, but you look at the XLE. I'm just going to pull up one more here from my my little thing here, but the XLE, here we go. Let's see here. Is this it? No. That's it here. There, okay, here we go. Let me put it on the bigger thing. Okay, now the XLE, as I mentioned, very, very bullish on this. And I showed you how it was, I showed you that chart, which was only a 2-year chart. Now we're going back several years. This is where I turned, again, I don't claim I turned wildly bullish here at the lows in March. It was here where I turned bullish. And so, but it's had this unbelievable move. And like I said, we turned cautious a couple of times. It worked out really well. But look at this thing now. It bounced off its 200-day moving average. We talked about why I think bullish, fundamentally why I think oil will do better. If it breaks above $60, the XLE breaks above $60, okay, not only will it give it another higher low, higher high reading, which it's had several of, it's going to take it above its 8-year trend line. 8-year trend line. That's going to be wildly bullish for this group. And it's still relatively cheap. It's not overowned. It's not overbought on a long-term basis. Look at the RSI. It's right in the middle. It's very neutral right now. So again, if the dollar comes down, it's not as strong as correlation as it is with some other commodities, but it's still a good one. So the dollar comes down, oil is going to go up, energy stocks should go up, and this thing's really going to take off. So these are the things that we're constantly looking at to see. And if you see that breakdown in gold, we're going to be looking at a lot of different individual energy stocks to be buying some call options in.
Yeah, absolutely. And there's a lot of things you're scanning in the market. So, I mean, that there's the trade flow inside the chat room is amazing because, I mean, it's also interesting, people that want to learn how the markets really work. Matt, what are your thoughts on the metaverse and these metaverse stocks, Roblox, Unity? How do you feel about that?
Well, let's get my thing up here. Well, first of all, I mean, the one thing you worry a little bit about is this, whether it be the government, what the government's going to do, and especially like for Meta, for Facebook, whatever you want to call it. They've had, it's an election year, and a lot of these Democrats, it's been a tough year for the Democrats, and for Joe Biden. I'm not trying to make a political any kind of comment about who you should vote for, who will do better. Just right now, they're having a tough time. If that continues, the Democrats in Congress will start looking for reasons to make themselves look good. And there's certain things that they can go into that will be really quite that the Republicans will push back on. Going after Facebook's really not going to be one of them. I mean, because it's a bipartisan issue, and they'll be able to find, because believe me, there'll be plenty of Republicans who will have tough battles to fight too. They'll jump on the bandwagon. Having said that, I mean, it's funny. I didn't even notice this. Well, actually, I talked about it a while ago, but I had forgotten about this. But look at this right here. I'm getting rid of my things here. Let's put this here. Okay. Now this is it. Shoulder, head, shoulder, inverse head and shoulders. You get much above. Having said all that, having said my concerns about that, you get above 355, and this stock's going to run till the daddy takes the tree root away, because it's an inverse head and shoulders pattern. Anyway, to go back on that, it's just a for this particular stock, I'm still a little bit worried for the political aspect because it is an election year, and a lot of people in Congress are, on both sides of the aisle, especially on the Democratic side, are going to need an issue to grab onto, and they can't wait for the summer to grab onto it. They've got to get the ball rolling, early in the year, and then they can make a big deal out of it next summer when we're getting closer to the election. They can sound like, hey, I really fought these guys because the thing about it is it's not so much in the past. It's been, we don't like it. These people are making a lot of money. Well, it's like they're just jealous. Right? In this case, it's like, no, they're making money. They're making money off me. My data is what helping them make money. I should be paid. This should. It works. It's a winning political battle. So I'm a little worried about this. Fundamentally, I love it, and like I said, technically, especially this one in particular. If it breaks, I mean, that's what I say. That's what I love about technical. I'm going to say something about technical analysis again in just a second. But if something in technical analysis tells me I'm wrong, I'll believe me. I'll change on a dime because I do like it fundamentally on a longer term basis. I like it a lot fundamentally, especially. I keep calling it Facebook, but I guess it's called Meta. But anyway. And we can talk about other individual stocks in that area if you'd like. But I just want to talk about technical analysis real quickly here, and talk about. I remember I said earlier, it's like it's actually fundamentally based. It's not just a bunch of guys drawing, or just a bunch of lines drawn on a chart. And think about it for a second. Everybody, the most fundamentally based institutional investor in the world who says, I never look at charts, don't care about it, the first thing they will readily admit that the economy turns up 6 months. I'm sorry, the stock market turns up 6 months before the economy does if it's in recession. And if we're at a top, the stock market tends to roll over 6 months before we fall in a recession. They will also tell you that individual stocks tend to, when they're getting hit, the stock tends to move up before their earnings really turn higher, and the same thing in the other direction. Why does this happen? But there's a reason this happens. It's not just, and that's where technical analysis comes in. You think about a company, let's say a company, they come in, they've been having a couple of tough years for whatever reason. And so what have they had to do? Well, they've had to lay off a bunch of people. They've had to close some plants. And then all of a sudden things start getting better. Well, then they say, okay, this last things get a little bit better. Looks like it's going to be consistent. Great. How long is it going to take for their earnings to get better? Oh, they'll get better quickly. Actually, they won't get better. They won't get a lot better quickly because they don't have the capacity to get things better quickly. All right. They've got to retool. They've got to reopen their plants, retool them, maybe open a new plant. They've got to rehire people, train them. That takes time. That takes 6-9 months, maybe even a full year. But these hedge funds and mutual funds and these big institutional investors, they have an army of analysts that figure this stuff out in advance. That's their job. They go out, they talk to their to this company's customers or their company's suppliers, and they come back to their portfolio manager and say, hey, XYZ company, they've been down and out for 2 years, but I'm telling you, their orders are picking up, their business is picking up, but it's going to take them a while to turn things, to get the capacity to really show it up in their earnings. But don't wait for 6 months to buy the stock. It's going, I'm telling you, it's going higher. And the portfolio manager looks at it and says, agrees, does all his or her analysis, and they agree. And they say, okay, great, let's start buying the stock. And so by the time the earnings really turn, the stock's already had a nice run. That's why things turn 6 months in advance. The same thing happens on the other side, because people think, well, as things get lower, humans, they don't like to lay off people. They don't want to lay off people. They know these people. So they drag their feet, hope things will get better. And that's why, again, the stock starts to go down before you actually see the layoffs and the bad earnings and things like that. But the key there is that this is a way for individual, smaller investors to look at, to see these change, because we don't have an army of analysts that get paid multiple six figures a year to do this analysis. This is a way for us to see it. Hey, it's turning before the real fundamental picture, and that's why I find it very, very valuable. And that's why if you talk to any of the really most successful hedge fund managers, Paul Tudor Jones, David Tepper, you name it. I mean, there's a million of them you could talk about. They all look at technical analysis closely. Stanley Druckenmiller, another one. Not saying it's their number one analysis. Not saying it's something they look, but it's not something they just look at a little bit. No, it's something they look at seriously. And again, there's a reason for it. It is based on fundamentals. It's not just a bunch of lines drawn. Some of them, it gets, and that's why when I get into the the technical analysis, I don't go too deep into some of these things. We talk a lot about head and shoulders patterns or inverse head and shoulder patterns, trend lines, moving averages, because they can tell you about momentum. I mentioned the MACD chart earlier. That's a momentum builder. I mean, we know this. Let's face it. It's a lot of money in these momentum-based algos now, the algorithms. A lot of money based on that. So when a stock breaks out, man, they just chase them. So that's another reason why we look at the technical analysis. But when we get too much into the nitty gritty, it does become a little bit, voodoo, mumbo jumbo. And so, I mean, again, I look at triangle patterns, and there's several types of those, wedge patterns and things. But when you get too far into it, I just think it becomes more complicated than it needs to be. And and especially when it comes down to one of the biggest things is they call pivot points, when a stock makes a higher high or a lower low, or a key level that's and again, one other thing about the technical analysis. Think about what they call an ascending triangle pattern. This isn't quite that. Well, we could say it is. So let me just see if I can draw it here, because there's not enough lines. But let me just see. What do you call this? An ascending triangle pattern. I'll pull it here. Okay. See, now this stock, and again, you'd rather have, there's a couple of points there. So you'd like to see it touch a few more times, but this is what I'm talking about. Why do we care about this? Besides the fundamental aspects that I talked about earlier, it's also supply and demand. It shows here, this stock keeps hitting the 355 level that we're talking about, and the sellers come in. And it's like, okay, that's key. But this is an ascending triangle. Again, it's not the best example in the world. But again, it's just like, well, wait a minute. The buyers came in here. Buyer came in kind of the same level, a little bit lower, but not. But well, wait a minute. The buyers came in at a higher level here. They're getting a little bit more confident. Then it went back up, but the sellers came right. Boy, the sellers did not. They didn't go any higher. Got to 355. I'm out. They sold it. If they came back, no, if they come back and buy it here, which we don't know they're going to do that because it just is where it closed on Friday, that would be another sign. So ascending triangle patterns can break in either direction, but they do tend to break because the buyers are coming in at higher levels. Once it breaks 355, it realizes that the sellers, everyone, they were like, no, I'm not. It's not, the portfolio manager saying to his traders, at the big institutions, that gets to 55, you stand there and sell it until it goes back further down, then I'll walk away for a while because I own millions a share and it's not going higher. But all of a sudden, it finally breaks above. What does that say? That means those guys who said, just stand there and sell it are saying, either they've run out of stock to sell or they've changed their mind. And so the big sell. So again, it's not just fundamentals, it's supply and demand. It tells you that these sellers who came back 1, 2, 3, 4 different times have finally said, I'm going to let it go higher before I sell anymore, or I've got no more to sell. And then it really goes. And that's why some of this momentum money can work so well. The problem, and it's also, some of these chat rooms where they do the pump and dump, and it gets a little ugly, which is too bad because they really don't follow they're doing it for artificial reasons, but at the same time, it is something that works because it's fundamental, it's supply and demand. That's what the market is. I mean, in many ways, the market really is just a measure of confidence that people have in the economy and at any given time, and an individual company at any given time. And that's why we have stocks that go, even though they're really good companies, go way too high because the confidence in that company and its ability to change the world gets too high, and the stock gets ahead of itself. And same thing in the other direction, where a thing like Peloton now, I'm be interested to see what happens with the stock because it's been such a poor performer. All the institutional people are saying, just get me out of the stock. I don't want that thing. And once that selling eases off, maybe we'll get a little bounce next year. It's one we'll be watching in the chat room very closely next week. But it's just, again, the confidence has gone completely out of the company. is it really that bad off? We don't cover the stock, so I can't talk enough about the fundamentals on that one as I'd like to. But again, it's confidence is such an important part of life, but it's also very important to the stock market. And the Federal Reserve has been giving a huge amounts of confidence to investors because of that emergency level liquidity and stimulus, and that's going to be it's already starting to leave. It's going to be less as we move into the year, and that's why I think we need to be a little bit careful next year. And we have a lot of different things going on. But anyway, that's really what my thoughts on this. And I started to ramble on about the technical analysis thing, but again, it is based on more than just a bunch of lines. And yes, it's an art, not a science. And there are times when we get head fakes, and that's we need to be careful. It doesn't work perfectly. If it did, we'd all be zillionaires. But it is something that can be very, very helpful because it is based on supply and demand and is based on fundamentals.
Right. Absolutely. Interesting take there. Matt, maybe do you think it's time to go over some stocks maybe, and
Perfect.
maybe follow up with them on the chat room with the members.
Right.
So, okay, guys. So it's your favorite time of the day. It's what you've all been waiting for. Go ahead in the chat and throw your ticker. Don't spam, one per person, please. And we're going to do our best to get to all of them. And Matt will be following up with each and every one of these that it makes sense to follow up trade wise related in the chat room. So, well, called it there, Matt. We got Peloton.
Well, yeah, it was funny because we've been talking a lot about this one in the chat room. Oops. Oh, there it goes. Yeah. I thought my screen had frozen up on me, but let's just, and we've been talking a lot about it, and I was just like saying, I just can't get excited about the stock. Now, this was look at here on I don't know if it's hard to see. Let me zoom in on, I'm just going to go for the last 6 months to zoom in on it a little bit better. But see right here, this was Thursday. And by the way, that's the yellow is 50-day, 100-day, and 200-day moving averages there. But let me get rid of the 100-day because it kind of makes the chart a little busy. But anyway, this, and people are saying, you think it's going higher here? And I was like, no, I don't. I mean, and I could see why the stock has just done nothing. It's been horrible. But my thinking, again, why I said avoid it was except for here. I mean, look at that big bunch, had a big jump there, had a big jump there, big jump there, big jump there. All of them lasted one day. The next day it went right, it either, went right back down. It's hard to tell I know this chart's small, but it went right back. And sometimes it opened, we're at a high level, and then but then each day. So I said, this is the same thing is going to happen. This thing isn't going any higher. And sure enough, it didn't. It didn't get clobbered on Friday, but it didn't go up any further either. However, like I said, this is a stock that was a darling for a lot of institutions, and they had to say, get me out of this thing. It's been a dog all year. When a stock, so look how oversold it got, okay? And it's still going to bounce back for 2 days. That was the only, and just kept going lower. Who wants to, get me out of this thing. I don't want it on my portfolio, but now you want to, but people, especially hedge funds, will look at a lot closer because it is oversold. It is washed out. Let's look at the weekly chart here. I'm going to show you something here. See how oversold this is? It's very oversold. This one, but what I would like to do, here we are, each of the last 2 weeks, I'm sorry, going into this week, the previous 2 weeks, the high on the stock was $43, okay? Each of the previous 2 weeks, not last week, but each was below that. If this stock can break above $43, now I know that's $7 above here on a percentage basis. It's like, oh my gosh, I'll miss a big move here. Well, if you want to buy it here, fine. But again, you want to be smart about it. Don't just be guessing, especially when a stock is washed out and can't bounce back. I talked about this with Alibaba and the other China stocks. I'd rather miss the first part of the move because believe me, this thing's got a lot of upside once it breaks out. So I don't mind waiting for it to get to 43. If you do want to buy a little bit now, use a tight stop, maybe 5%, and then wait to and then add to it when it breaks above 43. But with the options, it won't really matter because if it doesn't get above 43 for for another week, well, we'll buy the the $43 or the $45 options that go out another couple weeks. But the point is that once it breaks 43, it should run, and that's where we're going to use that the technical analysis and take advantage of those momentum-based algos, because they're going to wait until it breaks out. Why not? Why shouldn't we? And we can take advantage of it. So now this is a weekly chart. I just want to look at a couple other things here. One other thing, because we look at a Bollinger Bands chart. I don't want to inundate you with all sorts of different, like I said, we do like to use a lot of, what do you call it now? A lot of technical analysis, but we don't want to overdo it. But we're still some good ones here. Now look at this. Okay, oops, I want to go back to the daily. Let's see here. Okay, now. I'm sorry, I want to clean this up just so you can see it a lot better. Okay, well, I don't know if you can really see it. It's hard to see. Let me zoom in. Okay, before I zoom in, look how this is what's called a Bollinger Bands chart. Okay, now what the heck is this? See this gray line, or the green or gray line? I can't even tell. I'm kind of colorblind. But that is its 20-day moving average, not its 200-day. It's 20-day moving average. This purple line is the level that tells you it's 2 standard deviations above that 20-day moving average. And the orange line or yellow line is 2 standard deviations below that 20-day moving average. So it's a very short-term thing. But look what happened when it got here. Got a little below that line. That was a great opportunity to buy it. Got below that line here on a short-term basis. Great opportunity to buy it. Got right down to that line. Great opportunity to buy it on a short-term basis. Here it for a couple of days, then bounced. Then bounced. Here again, no guarantee, because it rode the line for a little while before it bounced. But it still gives you an idea that the low end of the Bollinger Bands, again, it's so okay. We're right there. I would like to see this stock, but it's been riding it. Again, it looks like it's like it did the other times when it was riding that line. When it finally bounced, it saw a real good bounce. So here's one where I say, well, if it gets to its 20-day moving average, which is 39.40, maybe I nibble a little here. Maybe if it gets below that Bollinger Bands chart, then I'm going to get more aggressive. But I nibble a little bit here. If it gets up to that 20-day moving average at 34.50, 34.40, whatever, I'll add a little bit more there. And then when it breaks above 43, I'm gonna add even more, et cetera. So I'm getting much more constructive, which is a big change from just a few days ago, because the end of the year, all that selling pressure from institutional, I think is gonna disappear.
Okay, all right. So got it. So for all the guys that are already in the chat, because I know a lot of you guys are already members of Matt's chat room, he will be following up with this in the actual chat room. Now we have another one here that you and I love talking about, MU. What I mean, you're pretty bullish on chips, right?
Well, I'm just worried, as I mentioned, I had been, but as I mentioned earlier, I'm just worried about the action in the SMH recently. The SMH was it's forming a megaphone, what's called a megaphone pattern. And it got sold off the last 3 or 4 days, surprisingly so. And the other thing too is that it did see this huge rally between December 20th and December 27th, huge rally. But that was from an oversold base. It seemed like the chips had just rallied hugely, but really they've been chopping around a lot the last couple of weeks. So I'm a little bit worried. But look at Micron here, as you mentioned. Now it was funny because I am a little bit concerned about this stock near term. It is a great company longer term. And we have to use a tight stop on this one because look at this. All right, we got, okay, oh gosh, boy, I didn't even see that. Okay, so here's a lot more, and again, I can, on a short-term basis, you can change our mind. I literally went from bearish to bullish to bearish again. These were literally for over the next few days, because people were asking how the thing is going to end, how's it going to do between now and Friday. That was a much more shorter thing. But here we are. You can see this double top, right? Big problem if this thing rolls over in a major way. Big problem. So that's the negative side. If it rolls over, that's a big if. Overbought, not as much as overbought as it was in November, but overbought there. Okay. So I'm concerned about that. If the entire group starts to get hit, this stock is going to, it's going to form a double top. One of the worst things in technical analysis is a double top, and it could come all the way back down and test that 200-day moving average again, which would be quite a drop. It would be about 20%. However, look at this. We got a bull. Now, the thing is, this is a golden cross. Technically, it's not quite there. Okay, with that's yellow line is the 50-day moving average. The 200-day moving average is still, people always say, oh, 50 above. No, it has to be, they both have to be rising for it to be a 50-day, to be a golden cross. And they both have to be declining for it to be a death cross. Technically, the 200-day moving average is still falling slightly, but it's close enough that it should do it, because the same thing happened here. Look what happened the last time we had a golden cross. Back in November of last year. The 200-day was slightly, but look at that nice run it got after that last golden cross. So this, if it continues, now we could get a little head. That's what I'm worried about. If you get a head fake, it rolls back over. But that is a bullish thing. So what I'm saying is, people were asking me in the chat last week, literally over the next few days, over the next few weeks, whatever happens to this stock, probably next week, is going to be really important. If it can rally back and take out this double top high, it's going to blast off. Because it's funny, early in the year, you have guys, what we call this, again, I spent so much time covering institutions, but it's been very helpful in my career in talking with individual traders, is because these guys come in at the end of the year. I told you about how they wanted to push up their best stocks and stuff like that. They also, at the beginning of the year, what they have, we call this performance fear. Okay, and I'm not talking about anything that has to do with Viagra. Okay, we're talking about performance at the end of the year. If you at the end of the year, if you're a portfolio manager who thinks the next year is going to be a horrible year and the stock market's rallying, doesn't matter. You still got to be buying. You got to be buying with both hands right into the end of the year, and then you can shift your portfolio if you want to, because you do not set up your portfolio and lose that year-end performance, because your bonus is going to be dependent on how well you did versus your bogey versus the market at the end of the year. Okay, but the same thing happens at the beginning of the year. If the market, you might think it may be the worst, this 2022 is going to be the worst year ever. But if the market is rallying, all right, and it starts up to a good year, you have to be in. You can sell later, because if you fall behind in the first month and the stock market's up 10% in the first month and you're only up 3%, you're spending the rest of the year trying to catch up to your bogey, okay? And those portfolio managers, anybody with any experience, doesn't do that. They're like, if the market's going, I got to be with it, no matter what my longer term feeling is. I got to be with the winners. Micron, if that breaks out above that level, which is, just obviously about 98, let's see, 97, 98. Okay. Especially if it breaks up above 100, and round numbers get used too often in technical analysis, but they are important. They are important psychologically. They're not as important technically, but you get above 100, this thing is going to run. Okay. So if this little pullback we saw the last couple of days reverses quickly and the stock breaks out, it's going to confirm. We're going to get a confirmed golden cross and a higher high and not a double top. This stock's going to run, and we want to be buying call options going out a couple of weeks, not just a couple of days. Okay. However, if this decline we're seeing here, which is only a couple of days old, turns into a bigger one, look what the last one did. I mean, it fell pretty hard. I mean, gosh, where did it go down to? Gosh, the stock's, just a few days, it dropped 10%. So it could do that again. I'm not saying it is, but if it does, okay, it's going to show that the RSI is right. It is overbought. It's a double top, and this thing's going to get hit hard, and we're going to want to buy some puts. So we're going to say very, very nimble in this stock. And I was wanted to, let's add the MACD. See, now it looks like again a little curl over. I know I'm not all that worried about that yet. It would have to go over, get hit hard. But my point is that this is an incredibly key time for Micron on a technical basis anyway. And whichever way it moves next week, if it moves again, it might, we never know, it might just kind of do nothing for a little while. So maybe it moves into the following week. But the next meaningful move, whichever direction that is, right now, I'm concerned about the markets. So that's having me lean on the bearish side. But with this, which I didn't notice, this golden cross has got me rethinking that very, very seriously. Again, it's only a mild golden cross yet, so I need more confirmed. But boy, this stock could really be a good one. It's going to be, I think, going to be a good one, a big money maker in January, one direction or the other. But as traders, we have to let the market. Don't try to jump in front of it. Too often, especially with technical analysis, people try to jump in front of it. Wait till it breaks that level, because that's when you get the confirmation. And especially a stock like Micron, which can be very volatile. It can see big moves in a very short period of time. So we want to be careful of that. But I must admit, I didn't notice. I'm glad you asked that one. I've been looking at it, but for whatever reason, I didn't notice the golden cross. So we'll be looking to again. This is one we are going to make money on this month, and it's whichever way it breaks. Probably this week, but certainly within the next 2 weeks is the way we'll go with it. But again, you just let Mr. Market tell you what it wants to do. Don't try to beat him in his own game.
Okay. All right. Let me throw in this one here for you, Matt. Vimeo, VMEO. I don't know. This IPO'd like it's $60 and it's like it's $17 right now. It's from what I understand, it's like the only competition to YouTube. It's like like videos, but there's no advertisements.
What's the symbol?
VMEO.
Okay.
Vimeo.
Okay.
Because I see some of these IPO stocks like, Roblox, and I see them, they have an IPO, they tank horribly, and then suddenly everybody starts liking them again.
Yeah, this is, of course, on a technical basis, it's hard to look at it because the stock is, hold on a second. The stock, it's been trading for 6 months, so it's hard to look at the chart and get a good idea. But, oops, I'm close that. Having said that, the one thing I would say that's good about this stock is that you can see here it's been building a base. I don't know a lot about the fundamentals of the stock, so I would have to look into that more. But look here, right between basically 17 and 1750, 1750. It's been building a base for almost 2 months, almost a full month. Okay, whoops. Oh, I see. Okay, I'm sorry. For a full month, that's nice, but you'd still want to see it move, move higher here. Let me just look at something here. I'm just kidding. Whenever a stock builds a base like that after a severe decline, MACD chart not really telling us a whole lot there. Again, it's hard to look at the chart on a short that's only been public for a short period of time. But as you go, go back to what you said, people been probably selling it because it's on its lows of the year. The people, institutional people might have bought on the IPO, and they're just said, get me out of this thing. It's been a dog, and then they'll take another look at it. But the fact, so I guess the point is, I'm gonna look at this thing here. Hold on. The great thing about this is VP bang. Oh, what did I do here? The wrong thing here. GP. Here we go. So the stock's trading at $17.90, about $18 basically. So $17.50. What you know is that your stop is $17.50. You get below $17.50, you buy the stock, you're out with a very minimal loss, and you're fine. If it breaks above, finally break, after building this base, can break above 1920. Okay, that was the high on December 7th. Pearl Harbor Day, whatever, December 7th. The 1920 or 1917, but I like to give it a few more pennies. 1920. Then you even add to it there. It looks like it wants to go higher. But it's a tough one to play right here. But I do like the fact that it's built this nice base, and I do like the fact that you have a very good level to look at to know that you're wrong. And if it breaks below 1750, you just get out of the stock and look for another entry point. Okay. All right. One more thing though. Hold on. Just before I do, I just want to look at the options too. The thing about this, the options are not. They're not overly active. Although, so you just need to be careful, and you see the bid-ask spread between them is very, very wide. So that's one you need to be very careful about. Okay. All right. Let's go here with Riot. That's RIOT. Riot. Oh yeah. Okay, now this goes back. This goes back before we had the chat room when we made some real multiple hundreds of percent on the options on this one. Now look at this. Now, as you know, as I mentioned on the what I was talking about with Bitcoin and such, I think that cryptos can. Oops, I went back too far. I meant to go back to 219. Sorry about that. Okay, now look at this here. It's it's obviously had the big move early in the year, and but look at this here. This $20 level has been key support. It didn't get all the way down to it, but you can see it's kind of bouncing around here. And again, I think it's one of those situations where like it is with the big, with Bitcoin and others, that the institutions have been saying, they've lost a lot of money if they got in this thing. Just look how much it's fallen. I mean, it's down 50% or whatever, but it's been holding that key May low. Okay, so my point is that it's oversold. Let me just look at the weekly, the RSI relative index, RSI relative strength index. Not so much on a weekly basis, but that's okay. It's getting oversold. Not wildly. It's not wildly oversold, but it's bouncing off an oversold condition. So I guess my point is, you definitely want to use $20 as your stop out on the common stock. That would be a 10% loss. So that's you certainly don't want to lose 10% anyway. Anything more than 10% anyway. But that's your stop out level. But I love the fact that here a couple of times you say, oh gosh, it held above it here, it held above it here, but it broke below where this here the July and October lows. Usually that would be a concern of mine. It's not, because let's blow it up a little bit so you can see a little bit better. Not as much for me for what I talked about before. I think it's only down here because of these institutions saying this is a loser. Get me out of it now. I'll take a new look at it next year. And so again, use that $20 stop. You break below that, it's going to have a big problem. And if it breaks back above, let's just go here. The options, you might want to wait because you just don't know how quickly that will go. But it gets back above 25.85, 25, 20, certainly 26. Again, but it's okay when you're in the options. You don't mind waiting and waiting for that, because you'll instead of buying the options that you may wait a week, so then you'll still be able to buy options that are relatively inexpensive. And you'll just be a little bit higher, but you don't care because you're buying the option, not the stock. And so then it gets to 26, maybe you buy the 20. It gets to 25.85, you buy the $26 puts. Basically at the money, slightly out of the money, or just slightly out of the money. This thing starts to run, you make a lot of money very quickly.
Okay, all right, let's go here with the next one. What do we have here? Seagate.
Oops. Sorry, I'm all thumbs here. Okay, so this is what's that? Seagate is SEDS. I'm going to say this is C limited. Yeah, so this is okay, good. Okay, good. Let's make sure I have the right. Okay, now look at this stock. Look how oversold this thing was in December. It got down to 200. Okay, this is incredibly oversold. Here, you worry about a little bit about death cross there, but I worry less about that. I think most people, because let's look at the stock. It hasn't had a death cross in so long. It's kind of hard to worry about that. But I'm going to look also at its. Look at 2 other studies. I'm sorry to do this, but I get all these things on here so I can look at them all at once. Okay, let's get rid of the moving averages, and let's get rid of these two things. Boy, this stock really looks interesting. Really looks interesting.
Yeah, okay. They have they do like these storage things, like like a terabyte, where you just put a bunch of things that you're storing, like documents. They're like in the electronic kind of space. They do a lot of that stuff.
And you look at the technical aspect of this thing. So These lines up here, remember what I told, well, let me zoom in so we don't have to. Now it's not extended on its Bollinger Bands, but it was right down here, right? And it was incredibly oversold. But more importantly, it's seeing a nice positive cross on its MACD chart. And it's held, see this here? See, okay, I'm gonna get rid of these because we don't care about the Bollinger Bands quite as much because it's not really a compelling one. I just wanted to see what it was. But look at this. Look how many times it's gotten to 200. Got to it there, got to it there, slightly below it there, but held right to it there, held again, okay? This thing is, and the MACD is trying to gain some momentum. It's coming off a ridiculously oversold level. This stock, and it's already above its trend line going back to November. I mean, this is a washed out. Let's look at the volume on the thing. I didn't. Okay, it's hard to see. Maybe I was going to. You can see, and it's hard to see here because it's such a small chart. I could take away these. I'll just. But the point is, the volume was quite high in mid-December. Okay, it's hard to see, but I can tell you that is the case. The volume. Let me. I'm going to take that out. I'll take these two things out. Just you can see at the volume only. But see how the volume was really big here at the beginning and stayed high. I mean, you had a couple of days here, but those are probably expiration days and things. But it was much higher. That tells me the stock got washed out, okay? I'll get rid of the volume, go back to the MACD and the RSI. So it got washed out in this horrible sell-off there. It's crossing, it's regaining some upside momentum. It's held this key $200 level again. So obviously if it breaks below 200, you want to get the hell out of this stock. You probably want to get out of it and then short it or buy puts. But this one has a lot of upside momentum. A lot of upside potential. And if it breaks above its recent highs of 228, it should really, really run. So this stock, I definitely want to be talking about Seagate. I see, that's a great one. That's a lot of potential there.
Absolutely. And for those guys that are sending me messages here, yes, Matt will be following up with these picks in the chat room. That's a pretty juicy one. Pretty good looking there. And
again, it gives us a key level. We know if this isn't working, we'll know when it gets below 200. It won't be any monkey business there. Like, maybe we should hold on a little bit longer. No, out.
Mm-hmm. Okay. All right. This is your other baby right there, NVIDIA.
Oh yeah. Again, this is such a great company. Such great prospects, but it did get NVDA. It did get way ahead of itself earlier this year. We made some real nice money in the puts and this one. Right now, the key for this one is we can see it's very neutral. It's nothing. Just again, I've said it a gazillion times. Just because a stock is a great company doesn't mean its stock. I'm sorry. Just because a company is a great company doesn't mean its stock is always a great stock. It's trading at 88 times earnings, 67 times forward earnings, no discernible yield. It's still expensive. That doesn't mean it's not going to go a lot higher, but you don't have that impetus to say, oh my gosh, I've got to buy this thing. It's dirt cheap, and it's definitely going a lot higher, especially if the Fed's going to be pulling back on some of that, a lot of that liquidity. Let's see what it is. Here it is, bang. See how expensive it is? I mean, it's 67 times forward earnings. It's very, very expensive compared to history. I didn't go back very far, but let's go to 2005. See, this is, the stock, you say, oh, well, the stock deserves that. Well, maybe it deserves a elevated one, but maybe in the 50s, but way up in the 70, 60, that has me nervous, okay? The stock is neutral on its RSI chart. I'm sure it's neutral on its Bollinger Bands. Let's see this. Okay, I'm gonna go back there. But the key, of course, I'll pull up its Bollinger Bands really quick. MACD and Bollinger Bands. Let's study. Bollinger Bands, yeah, that's nothing. I won't go there. And then, so it's just very neutral on that chart and very neutral on its MACD chart. See what it's doing here. Yeah, well, MACD it's trying to see a positive cross, so anything can happen. But the key, much more importantly, I'm going to pull right back up get all these crazy lines off of there. But you can see the yellow line, the 50-day moving average, is key support. But we also want to look at its 100-day moving average. A lot of people don't, but you see the chart right here, right in the middle, very, very neutral in its RSI chart. But look at this thing here. All the moving averages, the 50-day, it held it here, broke below it here, but held the 100-day. The 100 and the 50 were right there together. All three of them converged. All right. So the key right now is it broke below the 50-day moving average, but only slightly so. If that becomes a meaningful break, then we're going to be looking for this thing to drop to the 100-day, which is way down at 250. That would probably make the stock oversold. Now, if the market really gets ugly, then the 200-day. And then this is where you want to back up the truck. That's way down $210. That's a lot lower from here. This is a stock that, I mean, what I'll be looking at is if the market sees that big rally at the beginning of the year and it gets back above these recent highs, the closing high was 310, gets above 310, I'll have to turn bullish on a short-term basis. But I'm worried about the big move that's had. I'm worried that it's very expensive. And if it breaks below this 50-day moving average in a more significant way than it did here, you're going to see a fairly quick drop down to at least the 100-day, which it held back in October. Then we'll take a look at it then, look at the RSI chart. Now, I want to also look at the weekly. See the weekly chart, it's still, if anything, still overbought. And Joyce, look, if it really gets ugly, look at the 50-week moving average. All right, that's way down at $200. Again, you have the 200-day and the 200-week, both down near $200. That's if the market gets ugly. But I guess my point is, remember that if we get a tough market this year, anytime this year, especially if we get in the first quarter, or first 4 or 5 months, first quarter in particular, first 3 months, you get down to 200, that should provide rock solid support for this thing. If, again, that'll be the situation where people will be throwing the baby out with the bathwater. But a 200-day move, it's the 50-week moving average is at 199, and the 200-day moving average is 210. I mean, by the time if it gets down that much, it'll roll back over and be down near 2. So that 200, 210 level is where you're going to back up the truck and buy this name. I do want to look at one more here, again, which is another reason to be a little worried about it. That was the MACD chart, which I mentioned, but let's look at the weekly MACD. See, the weekly MACD is getting very close to a negative cross. Now, it has to be a significant cross. See what it saw? Even there, a significant cross, the stock only went sideways, so not a big deal. But at the same time, the Fed was providing all that liquidity. We did get a head fake here. It got a really minor cross. The stock went down a little bit, but then bounced back nicely. But if we get a negative MACD cross on its weekly chart, and you break below that 50-day moving average, you're going to have problems with this one. So I'm leaning towards the negative side on this one. It breaks above 310. I'll look at it again. Fundamentally, it goes back to the ones I've been talking about. Fundamentally, I love the stock. I love it long term. I love the company. Well managed, unbelievable. 5G. I mean, all these different areas where they're going to be, where they're providing chips that will do very, very well. But the stock has gotten ahead of itself. Just like Amazon and Apple and Microsoft, any of these names have done in the past and have needed to come down and see significant pullbacks before they really become great fundamental buys again. And I think that's the case with NVIDIA. So you break below that, much below that 50-day, I'm going to be looking at puts in this one, especially if the broad market, because the one thing about the stock market is everybody is certain. Some people say that the market's going to be okay because it's narrow. Somehow, that all these other stocks have already corrected, so therefore the market won't go down. But history says the exact opposite. History tells you that whenever that happens, the big names, the few small names that have been holding the indexes up, once they go down, much more often they go down than the laggards come back up. And I like to compare it to termites in a house. The termites, if they eat it, let's say 28% of the stocks have had are in bear market territory. So the market's really already corrected, already seen its correction. It's just been underneath. But I'd say it's like termites have eaten away at 28% of your foundation, not foundation, 28% of your frame of your house. I mean, that makes the house very wobbly. Well, the Fed has provided some braces. They put some braces up against the houses to keep that thing nice and rock steady, even though the termites have eaten away at 28% of the wood. Okay, now they're pulling away those braces, so that thing's going to get wobblier again. And and Nvidia is going to be one of those stocks that will likely lead it lower. Microsoft, and again, I talked about with the CEO selling Nadella saying $285 million worth of stock. Apple can never go down. Well, I hate to say it, Apple has gone down many times. And what may not happen immediately, if it happens, these are the stocks going to get hit particularly hard. So I guess the broad market does get hit next year. Nvidia, Microsoft, Apple, those names are all going to get hit pretty hard. And even though they're good companies, even though they got great prospects, and I want to be able to take advantage of them in both directions. And believe me, when stock gets down to $200 and $210, that kind of range, I won't be having any. I sure as hell won't have any bearish bets on, and I'll be looking very strongly at some bullish bets for that one. Okay, let's see here.
All right. So, Matt, how are you doing with time? How are you
Yeah,
doing
I've been doing this about 2.5 hours, a little bit more. So I think we're going to try to wrap it up if we could. I've really enjoyed talking about the markets. Obviously, I hope you get an idea of how passionate I am about them. One of the things it would be interesting to see how aggressive the market would be. One of the reasons I've been saying in the chat room that I think that if we do see some downside, it may not happen immediately. First of all, the Fed is still providing liquidity. They still want to have the Fed chairman confirmed. He has been nominated, but not confirmed yet. They do have to not confirm him by the end of the month because that's when his first term ends. But be looking for that. But again, it's going to be a really exciting time. I hope I'm wrong about the stock. Well, in a certain way, hope I'm right, because I think it'd be healthy if the market did see a correction of 10 to 15%. It's just, we went a whole year last year. We only had one day. Remember they said we only had 5% pullback. Haven't had a 5% pullback all year. We finally got one. It lasted one day. And so this is not a normal market. It's not healthy. Let's get back into that healthy market. It's going to be painful for those who aren't watching things closely, playing in an aggressive manner. I think it'd be very profitable for those who are. And it's in this chat room, we're looking at it every day, all day long. And it's I think a great way for people to stay in tune with what's going to be going on in the market. Take advantage of it. Use the tools that we haven't had in years past when we've seen the market pull back. We have them today, and it's going to, if you come along for the ride, I think it'll be a way to really maximize your returns, especially if the market does have a tough year overall. It doesn't mean we're going to have if we start a big correction, doesn't mean the stock market is going to end the year down that much. But if it does, or if it doesn't, we still looking for smaller returns than usual for those the old buy and hold game. I think that's going to be tougher to play, and for those of us who are doing it in a more active basis, I think are going to be able to far exceed those single-digit gains that I think is probably the best case scenario we can look for next year.
Absolutely, Matt. Well, number one, thank you for being here with us today. Appreciate your time. What are some? Yeah, no worries, man. Just what are some closing remarks here? What would you like to leave the folks here with, considering it's January 2nd? We're about to start the trading year for 2022. How are you looking at things now?
Yeah, I think it's the very early part of the year, as I said, it's kind of that micron. The thing with micron was such a good indication. I am neutral, but very much waiting to see how things play out early on, and we want to be able to take advantage of whichever way it breaks. As we move through the year, I think the odds are very, very good that we'll see a deep correction, and we want to be able to take advantage of that. But the point is, if you're passionate about the business, I mean, I guess I say, please come out and at least take a look at the chat. I think you'll really like it. We get, it's not just a fact of getting good ideas, but it's also learning. And we have guys on there who really talk a lot about different option strategies as well, about doing, selling certain options, doing straddles, doing other different kinds of strategies, buy rights, etc. These are the types of things that can really add to people's knowledge of the business. And it doesn't necessarily. I mean, when you hear about these strategies on our chat room, and then a lot of them that I don't really talk about. I try to concentrate on the real key turning points, but it's like, okay, now I'm going to go out and have a paper portfolio, and I'm going to try these strategies, and I'm going to go in and I'm going to buy the micron calls here, but I'm going to also check out this strategy and do a paper where I'm really going to buy those calls, and I'm going to put money into it, but I'm also going to test myself and see how I like this strategy with fake money, and I'll just say, okay, I pretend like I bought it here, and this is where I'm going to sell it, and you have a little paper portfolio where you can really learn some of these other different ways, strategies to make money. But the point is that it's a great group. It's not one of these things where you have 10,000 people on it who you never know what they're trying to accomplish. We're trying to make money for each other, help each other make money, and that's really what I just really think this year is going to be a really exciting year. Last year we saw some really big moves and made some real nice money and some real nice trades. Here's going to be one where I think that a lot fewer people are going to make money, because a lot of that money is going to be made on downside moves, but they're going to be made in both directions. And I just can't tell you how excited I'm about 2022. I think it's going to be for traders. Here's so much on TV and financial networks about it's going to be a stock pickers market. That is very, very true. But it's going to be a stock pickers market in both directions. And for those of us who play in that world, I think are going to do very well.
Absolutely. Well, thanks a lot for being here with us, Matt. Appreciate you. All the work you do here on behalf of everybody, retail traders. We want to thank you for helping us. Definitely the feedback, the analysis, the help. I see it every day in the chat room, what you do. And, they email me, they let me know like how much they've learned and all this stuff. So, it's good to see that we have something like this for retail now. So thanks a lot, Matt. I'll stick around here answering questions on the subscription, but thank you very much for being here with us, Matt.
Great. Thank you, Rodrigo. Have a great one.
You too. Okay, guys. So I'm showing you the chat room right now. This is in our own portal. It's in our own Premium Ideas portal. So we did put in a scanner here. I'm zooming in there so you guys can see. This is where I come in the morning or throughout like around midday, like lunch break. And I just have a quick look at the scanner. Right, I see. Look at this, down 98%. I don't know if that was a split, but you can see, Nutrabrand 165%. All these great trade ideas, right? So you're getting all these trade ideas delivered to you in the same chat room platform, okay? And then you pretty much pop in there. You talk with Matt about this, right? And you can bring your own trade ideas. Matt will have trade ideas. The point is that we all work together, right? As a community. That's why it's a great environment. Everybody helps each other out. Everybody's throwing picks, because this person might have seen something or researched, a certain part of this company, and maybe you didn't. So everybody helping each other is part of the Benzinga community. That's who we are as retail traders. We help each other out. Here is one of the sessions here that we recorded. On the right, we are putting some more sessions there as well. So if you do join, you will have access to all of the prior educational sessions that Matt is doing all the time. And there is a session as well. I believe it's on Tuesday or Wednesday. And it's for about like 20 minutes or so. It's a live call with Matt. It's only for the chat members. And basically you chop down the market, whatever's going on. Any questions you might have. It's like a huddle, right? Like a weekly huddle. And he'll always let you know if he's around. Like, look at this. FYI, I'm scheduled to be on Bloomberg TV at 3:40. So you can see that Matt's all over the place. CNBC Asia, like I've seen him randomly when I'm watching some stuff at night, of the news. So he's definitely active in the markets. And you as a retail trader are pretty lucky and spoiled actually to have somebody like this, a chief market strategist. These folks don't, they don't give retail trade ideas like that, So being able to have somebody from coming from there, from Wall Street with 40 years in the game, who's been doing it for a long time, a true analyst researcher, it's definitely helpful. I promise you that. So, and below here, we have a couple charts here. I was looking at some of these charts we were talking about, SE. So this is something I typically do if I find a trade idea either in the scanner or within the chat room, because we're always talking about, like, the conversation is so rich that, once you're in there, you'll see what I'm talking about. But yeah, we talk about pretty much anything in the markets. And let's see, we're looking at SC. So wherever you get the trade idea, it doesn't matter, right? You just come in here, you pop the ticker in, you can put your own analysis. This is an RSI with a moving average there. So SC is looking pretty juicy. I do like that rounding floor there. So this is some of the uses that you can put in. And once we have the meetings on Sunday, not Sunday, Tuesday, Wednesday, once you have that meeting, that link is going to be in the chat room. So you're going to be able to have everything there in the chat room, the sessions, the picks, the trade ideas, any video charts that Matt is sharing with you guys. It will be there in the chat room. And the laptop as well is included. So the first 10 people that do join get it. I'm going to show you really quick on the checkout what it looks like in case. All right. So if you see a laptop on the checkout, that means that you're getting one. Okay. This is the full price, $6,100. You're paying $1,297 for the year. So that is pretty good deal if you ask me. So this is the scanner, correct? The one that's on the top right. It's included. You don't have to pay for it. And we're going to keep adding more things. It's a commitment we have to retail traders to always keep improving our services to help you better. So these things that you're looking at on the side, those things are new. We recently added them. We're going to add more, but even better. End of January, beginning of February, we're going to release a new platform, Benzinga's platform. So it's going to be this times 10. New look, new feeling, a lot of features. So it genuinely is like a trading room, right? It's a trading room. And because we meet in different places, we're just talking all day, but we can't be on the phone all day because, everybody has things to do. So this is the best way for us to be able to communicate and gather as a group and trade together. So let's go over some questions here. Hey, BNZ Trading, if you want Bloomberg terminal, it's only for equity research guys, but Matt Maley does research there, and he obviously gives you guys the scoop on things that he's finding that are interesting, right? So, but that's Matt, right? That's all Matt. All right. Hey, Richard, appreciate you too, man. B Matt, you'd have to send me a quick email and I'll be more than happy to go over that with you. But yeah, basically, Matt Maley does stocks and options and little crypto as well. And keep in mind, what I do like is just the filter, right? Filtering things through Matt. That's what I like, because as retail traders, sometimes we can come up with some really bad trade ideas, to be honest. And having somebody who's experienced 4 decades doing this professionally, right? Not trading from your house or nothing like that, like an actual equity firm. That is the kind of experience that I do believe is trustworthy. It's valuable because 40 years, you can't go to school to get those 40 years of experience. So experience and education combined, it's just great for you guys to have this as retail traders. So yes, Matt, I'm posting the contact in the chat and just feel free to reply there. Andre, all right, let me go over this chat 1 second. How do you access the chat, Andre? You have to, so click on the link that I'm putting in there. It has like 78% off. And yes, it comes with a free laptop. That's correct. It comes with a laptop. It is included. Yes, I'm posting it on the YouTube chat as well. So, all right, guys, if there's no further questions here, I'm just going to leave the contact and the link. Feel free to reach out if you have questions on this or, that kind of stuff. And Farouk, it's a new Google Chromebook. You don't have to pay for it. You don't have to do nothing. It's our courtesy gift. It's our Christmas gift, New Year's gift. We're just hooking you up, and you don't have to give it back. So just do whatever you want with it. I would recommend use it for trading, have a little trading journal there. And you can do whatever you want with it. It's yours pretty much. It's our courtesy gift. It's labeled as a gift. So the first 10 people that get in will get the laptop. If you see one in the checkout, that means you're getting one. So Any other questions, guys, send an email. I'm going to leave the stream here running for a bit, but I do have to get back to sending some emails. So I want to say that I appreciate you guys. Thanks for being here. Thanks for supporting Benzinga, the mission that we have to help retail traders, to empower retail traders across the world to become more successful traders with the right education, with the right tools, with the right community. That's what we're here for, guys. So anything else that you guys need, send an email and we'll talk later. So I'll see you guys on the next time.
The Fed action has been tightened since November, first of all. So, this whole thing may not really kick the market in the teeth for a couple of months. I readily admit that. It came back up, the yield curve steepened a bit, and then it rolled. It's working pretty well, but it's only been one day.